when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Generous. Thank you very much. Mr. President, thank you for that introduction. It's wonderful to be back in the Republic of Korea. President Yoon, I'm honored by the welcome you've given me to your beautiful country. Congratulations again on your election. Congratulations. And recent inauguration. I and my country look forward to a very productive few days together where we can get to know one another better and explore ways to take the alliance between the Republic of Korea and the United States to even greater heights than it already exists. And Vice Chairman Lee, thank you for welcoming us to this Samsung semiconductor facility. This is an auspicious start to my visit because it's emblematic of the future cooperation and innovation that our nations can and must build together. I'm joined by my Secretary of Commerce, Secretary Raimondo is here in the front row, who's working every day to bring us closer to that goal. I've just seen how this plant makes the most advanced semiconductor chips in the world. They're a wonder of innovation and design, precision, and manufacturing. Semiconductors power our economies and enable our modern lives, from our automobiles to our smartphones to medical diagnostic equipment. And when it comes to the most advanced chips, like the ones made here in Samsung, is only one of only 3 companies in the world that makes these chips. It's incredible, an incredible achievement. Because these little chips, only a few nanometers thick, are the key to propelling us into the next era of humanity's technological development. Artificial intelligence, quantum technologies, 5G, and so very much more, things we haven't even thought of at this point. This plant also reflects the close bonds and innovation between our countries. Much of the technology and machinery that is used to make these chips was designed and produced in the United States. And by uniting our skills and our technological know-how, it allows the production of chips that are critical to both our countries and are essential sectors of our global economy.
The President of the United States there, he is alongside the President of South Korea at a campus owned by Samsung. Tom, the dependence on China, the dependence on chip production in certain parts of the world, a key issue for this tour of Asia for the President of the United States.
You know, it's technology first. Samsung, it's 3 nanometers, and don't ask me what that means, John, other than Samsung's winning the game right now, and we would like them to win the game in the United States of America. John, this plant directly south of Seoul, a good distance, but what this trip is really about is unchanged, is the distance from Seoul to the DMZ and the border. It's only about 46, 49 miles is my recollection. In the image for radio, John, is a masked set of people behind him. And that's one of the backstories here is COVID is still front and center, including the new COVID north of the DMZ.
Lisa, this particular trip runs through the weekend into Tuesday. I believe it also includes a trip to Japan over the weekend.
Yeah, how much is he going to shore up some sort of idea, some sort of partnership ahead of China and the potential invasion of Taiwan? We did see some exercises to try to do some saber rattling ahead of that. And how much is the focus going to be on these semiconductors, especially given some of the shortages?
Live from New York City this morning. Good morning to you all. If you're just tuning in, equity futures are positive by more than 1% on the S&P 500, on the Nasdaq 100 up by 1.5. The earnings keep pouring through, Tom. The latest Deere just moments ago.
Deere with, I thought, some snazzy numbers. The stock lifts 4.2%, I believe, is the statistic. But, John, I thought it was a pretty good set of numbers spirited by nominal GDP. You go up 9% on one measurement of sales, and that's about right, given the inflation lift of the top-line GDP.
All about the outlook here, TK. The stock's up by 4% in the pre-market. The outlook, they now see full-year net 7 billion to 7.4 billion. They had previously seen 6.7 to 7.1. I believe the estimate was something in and around 7. So a little north for the outlook, Tom. That's decent news for that stock.
All wrapped around the food shortage. Lisa featuring that painful UN chart, which is of international interest and emerging market interest. That brings us to Damien Sassower. It's been way too long since we've checked up with him. Chief Emerging Markets Credit Strategist for Bloomberg Intelligence. Damien, the dollar resiliency we're seeing is all focused on the big pairs, Plaza, Accord, Worry, and that kind of stuff. What does resilient dollar mean right now for EM?
Well, I think you have to look at it through different lenses, Tom. I mean, dollar strength is broad-based. It's something that emerging market practitioners have learned to grow accustomed with. But if you're a true emerging market investor, it's all about your funding currency. And if you funded, for example, in Japanese yen this year, you find that the 20 major EM currency pairs are all positive on the year from a carry perspective. So again, dollar strength is something that we've learned to contend with here in the emerging market space. It's about finding the right funding currency, yen, euro, whatever it may be, in order to fund your positioning out abroad.
As Biden heads to Asia, China announces additional rounds of trying to stimulate its economy, cutting that 5-year loan rate by the most on record. How much of a stimulative effect do you think that this will actually have on the region?
Well, Beijing has welcomed President Biden with open arms by conducting military exercises in the South China Sea.
I know.
I mean, that's really where we are. I mean, look, the 15-bip cut in the 5-year is designed to kind of alleviate some of the stress on the mortgage sector. But the lockdowns are the big story there. It's demand for loans, it's demand for lending, demand for credit in China, which is lagging. And so, it doesn't matter how much stimulus you're going to inject into the system at this point. You have to kind of free up people. You have to get consumers out spending, and you need to get labor out working. And that's really the issue in China right now.
Damien, just a final one from me. The important work from home question. How many screens does Sassower have in the home office?
Well, I mean, look, it's a toxic brew back here behind me. I mean, we all know that. So, now, look, I have 2 screens. I think that's mandatory by Bloomberg. You have to have 2 flats. But, for me, it's going to be about Rory McIlroy this weekend. Jonathan, I know you and I will both be watching. I mean, who's going to be watching the Red Sox? I mean, not many people. So,
Thank you.
Does anyone do that anymore, Tom?
No. Well, last night was actually glorious. But, John, what's really important here to understand is when Damien logs on in the morning, Quebec Hydro has to assist New York State with their electricity pickup.
Damien, thank you, buddy. As always, Damien Sassower of Bloomberg Intelligence.
Can we have his life? Can we just,
It feels pretty laid back, doesn't it? Golf on a weekend, a lot of sport.
A little toxic brew.
He's got that backdrop at the PGA. He's out at the PGA. He's got.
You've been watching the golf, Tom?
I watch it for a little, but I just can't sit there.
Do you know what, Tom? It breaks my heart to see Tiger struggle. I just hate to see it. I hate to see it. It's almost painful. I don't like watching it.
Actually, was dinner conversation last night, and I don't know what you do, John. It's outside my...
First few holes, Tom, he did really well. He's so talented still. You can see it, but it's just the body just doesn't seem to be there right now.
Well, these guys are very visible. They whatever the sport, they run out of steam. I mean, it's sort of like Blackpink. When Blackpink is singing, they get fragile. They run out.
What is that? What is that?
Blackpink is, they're like these girls are really doing it in Korea, and
is this K-pop
they're
again?
not BTS.
Okay. Can you give us an idea of a song by who?
No, I'd like to do a Blackpink lyrics, but if I did them, on radio,
Okay.
I'd be in trouble.
We know that it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccines specifically, neutralize the virus, but not as efficiently, because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines, and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Right now, we have an incredibly strong economic outlook. Certainly, inflation is a concern, and I agree with that.
A recession is at least a 50-50 bet, given how far the Fed's likely to go. It's just that the timing is pretty far down the road.
The Fed does its thing. I'm going to place an order to sell short Japanese yen. If you're looking to trade today, please place your order at 128.055. Okay, place your order to sell short Japanese yen. Okay, stay with me. These days, the trading on your screen, what we publish, quite slow. We trade other things behind the screen, but every time when chances, opportunity arise, we always place the order, and I always tell you what to do. If you want to find out how we trade, you need to get the strategy. The strategy is available on www.companyeye.co.uk. You can get the strategy and you can find out how we trade, how we make a profit from day trading. I'll speak to you later, guys.
And systemic event and unemployment rate rise is required first. Hartnett goes on to say, Tom, the bottom tactical line is the tape is very vulnerable to a bear market rally, but we would still argue sell any rips. And that's what's happened here. Over the last 10 years, it's been about buying the dips. This market more recently has been about selling the rips.
Really, really well said. But John, what I would add to that I think is so important is along that continuum of the summer, and particularly after Target and what we saw at Kohl's and the others, John, these corporations, including airlines booming, are going to adapt at light speed.
What a tough week for the retailers. And Tom, I'm pleased you brought up the airlines, because Lisa, if you just had the airlines this week and we heard from them, they'd tell you consumer demand was great, price tolerance was high, but then you hear from the retailers and they tell you something else.
Yeah, honestly, this has been the issue, is that right now we are looking at a tale of many different industries. How much is this? And we keep harping on this, but this is really the big question emerging from the week. How much are we seeing a massive compositional shift from both from goods to services that really is not anything in the history books, just simply because of the pandemic? And how much is this a real deceleration in spending momentum?
Is it a Wall Street problem, or is it a problem for the broader economy? I think is what you're trying to ask here, Lisa, and it's really, really important, because what we're seeing from the C-suite is them just struggle to find the right balance. You have gone on and on about this over the last few weeks. They've gone from understaffed to overstaffed, undersupplied to oversupplied in a blink of an eye. And some of these corporations are set up for the demand of 2021. In 2022, it's a different story.
Okay, so I keep going back to what Stephen Stanley of Amherst Pierpont said. He was talking about how we look at this as a glass half empty, right? That basically the companies are seeing their margins shrink, which suggests that they cannot pass along the price increases to the consumer. It could be the other way around, right? I mean, they could be ready to actually jack prices up that much more. This is the big question. Can they? We don't know. That is inconclusive. Do we really see evidence that they cannot pass along those higher prices to consumers? Or is this an issue of a precursor to even more inflation?
Glass half full, glass half empty. What did we say earlier this week, Tom? Someone said to us they're struggling to find the liquid in the glass through much of this week.
Yeah.
That's what the feel has been like.
That's the Tang theory. John, to me, the statistic of the week, and you're living it with your family in the United Kingdom, is 9%. I mean, I'm sorry, 9%. I have never said this in the modern era, John. How close are we to double-digit inflation?
Tom, 9's not the story. Here it is. It's not over. It's not the worst of it.
Yeah.
It's not like the United States, where you can say the peak year-over-year figure might be in. In the UK, they don't think it is. In Europe, they don't think it is. It could get worse before it gets better. Futures right now are more than 1% on the S&P 500. On the NASDAQ, up by 1.4. Yields on a 10-year look like this, up a couple of basis points to 286 on a 10-year. In the FX market, euro-dollar 105.77. Euro-dollar down by 0.1%. Crude firmer by 0.2%. WTI 112.45. Let's get to Michael Collins, Senior Portfolio Manager at PGIM Fixed Income. Mike, I want to start with this week and how gloomy it's been. Have you found the same?
You know, it's really funny, Jonathan. I was thinking the exact same thing yesterday. I had an old rule of thumb that's worked several times throughout my career. When every single headline is negative, it's time to buy, right? And to your point, I mean, this morning, every headline, except maybe the Chinese rate cut, is negative, right? I think the pessimism out there is really remarkable. It's really widespread, and typically that's what sets up buying opportunities.
Michael Collins, critically here in the IG space, the corporate space, I love your paragraph on that. It's a stochastic moment. You have to catch the falling knife to pick up price, going for higher price, lower yield. How do you determine when to load up on a beleaguered IG?
Yeah, I mean, we actually cut credit risk last year quite a bit because valuations were tight, right? Spreads were too tight. And this year, we cut credit risk even more because we thought the tail risks were really elevated. And now, a lot of those tail risks, the recession risk, which I think is a foregone conclusion, is really baked in and is starting to get almost fully priced in. And what you do, you look at credit spreads, right, Tom? So investment grade corporate bond spreads were at 80 basis points over treasuries. That was really full. They've almost doubled, right? They've gotten to that 150 territory, which historically is pricing in a pretty high probability of recession and certainly starts to flash value to us. You get into 160, 70, 80, you're supposed to buy aggressively. And the high yield market, I would say, has similar trends.
Mike, I remember a couple of months ago when you were saying buy the dip that you're seeing in bonds. And then you retraced that a little bit. You said, wait a second, we actually don't really know because this is a new circumstance. Where are you on that, given the fact that there is an inconclusive view on how determined the Fed really is to go at this hard and commit to that path that's currently is being priced in?
Yeah, that's exactly right. So I've just talked about the credit side, and even that's not that conclusive, right? I mean, there are opportunities emerging. There are a lot of cheap bonds to buy, but it's not time to get all in yet into credit. We're just starting to add here, looking for opportunities. On the rate side, Lisa, you're exactly right. I mean, 3% kind of across the curve feels like good value, feels like probably a high watermark. And I think in 3 years from now, you'll look back and say, wow, I wish I owned more bonds at a 3% yield. But man, in the next, several quarters, could the Fed continue to lean even more hawkish? And that 3% funds rate that's priced in, could that move to 3.5 or 4? I mean, talk about inflation in the UK. Inflation in some places is continuing to accelerate here. I don't think we felt the full implications of the supply shortages in Russia and Ukraine, and the shutdowns and lockdowns in China are still going to work their way through the system. So you're going to have more supply imbalances. And I do worry that there's a risk in the near term that funds rate that's priced in goes higher. And that could move yields a little bit higher as well. So we are neutral on duration right now.
So that's exactly where I was going to go with this. How do you really engage with this market with that kind of band of uncertainty? What does it mean to be neutral? How do you then stay fully invested, or do you just go to cash and wait for some trigger to reemerge?
Yeah, so when we're neutral, right, it's simple. You have a benchmark that has a duration of 5, you're at 5. You have a benchmark that has a duration of 15, you're at 15, right? So we're really making sure that our clients who define their duration profile based on their liabilities and needs, that is met, right? So getting long duration means that we actually think rates are going to come down, or at least they're under, they're cheap. And I actually think, again, over the long term, you're supposed to be covering that. If you're short duration, this is a good time to add.
Michael, I want you to speak to people who aren't sophisticates. They're not buying the spread market. They're buying a managed product. And on price, their South in bonds has never been seen in modern history. They're down 3 years coupon, or however you want to measure it. How do they claw back? How do they reposition in fixed income to begin to make up the horrific damage?
You start adding fixed income now. There's no doubt about it. I mean, the yields on a lot of these portfolios we manage, even higher quality ones, have 5 handles on them now, right? High yield yields are in the upper single digits, and the bond math starts to become really compelling when you're starting with these mid-single digit coupons, right? Even if rates go up another 100 basis points in the next 12 months from 3 to 4, right? Your downside in this kind of portfolio is like you lose 1% or so, right? If rates fall 100 basis points over the next 12 months, you can make low teens, right? So, I mean, the math, the bond math, the upside downside starts becoming really compelling, Tom, at these higher levels of coupon, higher levels of yield. And I think the forward-looking returns are really attractive in fixed income.
Mike, earlier this week, Tom said the stocks guys were smarter than the bond guys. What would you like to say back to that?
Yeah, the bond market is the center of the universe. We all know that, right? And
that's right.
And the bond market is leading the way here.
I just love how he said that with such a straight face there, like it was a serious one. Mike, thank you, buddy.
That was perfect.
Seriously, what he just did there was really important, because it describes what's called a non-Gaussian log normal distribution.
It's called a slapdown.
At this point, John, what that means is the return is wildly asymmetric. Yeah, you can lose on the downside, price down, yield up, but it is a double-digit home run trade if you get it right, price up, yield down. That's log normal.
Elisa is the center of our universe as well. Bramo, we talked for a while, didn't we, when yields started to back up? When would PGIM start buying? I think we got the answer.
Yeah, exactly. Maybe. I don't know. I mean, honestly, this sort of interesting take of basically such a wide band of uncertainty that you got to stay neutral. Maybe if you're underweight duration, you can add back in. But right now, it is so hard to call what the Fed is going to do. And frankly, the ramifications longer term are pretty substantial. I mean, let's say the Fed backs away.
Sure.
How much does the long end get completely uncontrolled if you really see the inflation that a lot of people are talking about in the economy.
The Fed backing away is not a call. The Fed's going to back away. That's inevitable at some point. It's the threshold, the conditions that we need to see, which push the Fed to back away. That's the big call, isn't it, Lisa? And I think that's a much, much harder thing to say.
Right now, why would they back away? I mean, they haven't even started to reduce their balance sheet. Yesterday at 4:30 p.m., I looked at their balance sheet total.
Of course you did.
And it's actually been increasing over the past 3 weeks, just to give you a sense, marginally. But still, I mean, we're talking about tightening. No liquid in the glass. There's plenty of liquid still in the glass.
QT starts in a couple of weeks.
Right.
You know what Lisa asked me?
What did she say?
She asked me if they play Oscar Peterson at the piano bar. And I didn't.
I know exactly what you're focused on.
I just didn't know what to say.
Your pub crawl next week.
Yeah.
Yes.
It's more like Neil Diamond's Sweet Caroline.
I know exactly what you're
you want me to sing that, John?
Please, go on.
Oh, please.
You know, you've got some time.
It's a very
Go
Red
for
Sox thing.
Don't tease us.
Well, K-pop, they're doing it. Blackpink's going to do it. Sweet Caroline.
Okay.
Whoa,
nice.
whoa.
Nice. Stocks up. What happens if stocks are down? What song have you got?
I don't know.
No? You have a think. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Joe Biden is on his first presidential trip to Asia. The president toured a Samsung semiconductor facility in South Korea today as he pushes to reduce reliance on China in the supply chain. Later on the trip, he'll meet with regional leaders in a bid to build support to counter security threats by China and North Korea. There's speculation that Kim Jong-un's regime may conduct its first nuclear test since 2017 whilst the president is in the region. More aid is on the way to Ukraine. Group of 7 finance ministers meeting in Germany are set to agree on more than $19 billion for Ukraine to guarantee the short-term finances of its government. That's according to Germany's finance minister. Meanwhile, the U.S. Senate has passed an aid package for Ukraine worth more than $40 billion and have sent it to President Biden for his signature. And the administration said it was providing Ukraine with another $100 million in military assistance. Finland is becoming the 3rd European country to be cut off from Russia's natural gas. Like Poland and Bulgaria, Finland is refusing to pay for fuel in rubles. The lost supplies will probably have a limited impact on the Finnish economy. Russian gas accounts for just about 5% of the country's energy mix. And in China, banks have taken a step aimed at boosting the ailing economy. They cut a key interest rate for long-term loans by a record amount. Lowering the 5-year loan prime rate would reduce mortgage costs. It also may help counter weak loan demand caused by a property slump and COVID lockdowns. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Ritika Gupta. This is Bloomberg.
Companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management. It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
Next week, Bloomberg is live from the World Economic Forum annual meeting in Davos. Against the backdrop of war, climate crises, economic upheaval, and a global pandemic, our all-star team is there, reporting on the solutions being discussed by more than 2,000 leaders and experts from around the world. Coverage starts May 22nd on Bloomberg Television and Radio.
The global semiconductor shortage has caused a shortfall in consumer goods, especially automobiles, and it's contributing to higher prices around the world. And now, Putin's brutal and unprovoked war in Ukraine has further spotlighted the need to secure our critical supply chains so that our economy, our economic, and our national security are not dependent on countries that don't share our values.
The President of the United States just moments ago speaking in South Korea. His tour of Asia begins this morning. Futures are positive by a little more than 1% on the S&P 500. On the NASDAQ, we're up by 1.4%. Yields are higher by about a basis point, a 10-year Tom, 285.14.
Market's really on the move here. A little nice improvement. Again, the VIX, 28.70. Right now, Anne-Marie Horton in Washington and Maria Tadeo in Bonn, Germany. And Maria, I have to go to you on not breaking news, but a story that has stumbled out over the last 4 or 5 hours. Thank you, Ian Bremmer, for bringing this to my attention. We hope to see Dr. Bremmer in Davos. Maria, this is not just about Gerhard Schroeder with perks taken away and finally, 15 minutes ago, resigning from Rosneft. But it's also about Matthias Warnig. These two are joined at the hip with Nord Stream. Warnig was perhaps an acquaintance through the Stasi of Mr. Putin, working for the Russians at a time. Maria, just brief our international audience on what a mess this is for Germany.
Well, Tom, is the real-time implosion of 25 years of Russia policy when it comes to Germany. This is something that for the German establishment was an embarrassment. We knew that it was going to happen at one point, and now today, of course, we see that the former chancellor is trying to break away those ties with Russia. Of course, for many, the damage, the credibility, particularly when it comes to the Eastern European countries, the damage has been done, but this was a long time coming now. He's making it official, and for the German government today, which, by the way, is the host country of the G7 I'm in, this is going to be a relief. At this point, it was proven to be not just uncomfortable, but incredibly embarrassing and also a symbol of this failed policy that is Russia when it comes to Germany.
What does it mean for the political quagmire that is Germany? Is Scholz history, Maria?
Same party.
Well, it's complicated to say because this goes all the way back to the SPD, but it's not just the German socialists, Tom. The issue here is that the problem is not just the SPD, the socialists, Angela Merkel, the CDU. It's almost the entire political and business system of this country that had become incredibly connected for Russia. You could say there's many reasons for it. You could argue a lot of this is war guilt. The Germans did feel a lot of horrible things happened in that great war with Russia. They wanted to make amends. You could go to the recent history. This country was separated, divided in two, a part of this very connected to the Soviet Union, but also the money, Tom. You have to think that Germany is a very energy reliant industry that for made in Germany with cheap Russian energy, they were making a killing. This was good business for a lot of people. The combination of all of this now is coming, however, to bite with the situation in Ukraine. It's becoming unsustainable for the German government.
And meanwhile, Anne-Marie, how much are we out of the frying pan and into the fire when it comes to some of the alliances that are being drawn up to try to shore up oil and gas supplies? And I'm not just talking about Europe, but also with the United States.
Well, when it comes to oil supplies, we still have Russia delivering oil to China. I believe there's a story out this morning on the Bloomberg terminal that more than $6 billion worth of crude the Chinese are buying up from Russia. And then, of course, India, which is an ally of the United States, which the president will be sitting down with as part of the Quad in Tokyo. These two countries are still buying Russian oil at the same time the rest of the world has really been shunning it. But it's a difficult line for the administration to walk because while they do want constant penalties against the Kremlin, it is hard for them to want to see all of Russian oil come off the market, even if they don't say it, because higher oil prices means that it's just going to trickle down to even higher gasoline prices for consumers. And clearly, it is so obvious their biggest domestic challenge is inflation, the grocery prices, gasoline pump, and the likes.
Meanwhile, Anne-Marie, we're hearing about this meeting with possibly Mohammed bin Salman in Saudi Arabia with President Biden to shore up more oil supplies. We're hearing from the Republican side, why don't you do more to produce more on the domestic side? This isn't really an oil story, though. This is a refined goods story. This is a gasoline story. Can you bridge that gap for us in terms of what really that can do, even if they get more oil and bring the price of crude much lower?
It's a nuance that no one in Washington is talking about, and Javier Blas put it very succinctly yesterday. When you look at spare capacity in crude oil, that goes down to the kingdom, right? Saudi Arabia has it. They're the ones that can pump more. But when you look at spare capacity in refined products, that is China. China is the only one that has that capacity to turn that crude, or more capacity, turn that crude into the products we use every day. Jet fuel if you're taking a plane, filling up your gasoline pump, diesel if you're driving a truck. So this is the issue the market has right now, that even if there was more oil barrels to come on the market, it's going to be very difficult to have the refining capacity to turn it into actual products. And that is a nuance that no one in Washington, D.C. is talking about. It is just too nuanced into the oil market for people to get a grasp of. It's either, do we have the gasoline and oil or do we not?
AMH is also very difficult at the moment to try and reconcile what they're doing on the foreign policy front with their domestic goals, and that's been a story now for about 12 months, hasn't it?
Yeah, it is difficult. The president speaking to it just at the start of this program. You guys ran a little bit of a clip with him in Seoul touching down, touring a Samsung facility. Part of this Samsung tour and what he's going to try to bring in the foreign policy, what he calls it, of American middle class. So when he's there at Samsung looking at their mega facility for chip manufacturing and semiconductors, he's going to talk about the one that they're trying to build in Texas. And he's going to point the finger at Congress that for months has still been dragging its feet. They're now in a conference between members of the House and the Senate to try to come to an agreement for this broad-based package on China competition bill, and it has more than $50 billion for semiconductors. And the president was pretty direct with Congress saying, quote, pass the damn bill, and that's going to be part of his foreign policy. But it's a tricky moment for them right now, both foreign policy and domestic, and how the two intertwine.
It's uncomfortable. Anne-Marie, thank you. AMH down in D.C. Maria, thank you to you as well. The president's first trip to Asia as president continues through Tuesday. He'll go to Japan, Tom, later this weekend.
It's fascinating, John, and the heart of the matter, as Ambassador Hormats told us yesterday, is the collapse of TPP by the Democrats, by the Republicans. He's trying to pick up the pieces, plus deal with the new China at the same time.
And of course, Tom, as you know, TPP has a massive branding issue now for this president in this White House. But ultimately, the strategic goals of it, TK, I think they still stick, they still hold.
Yeah, they've gone around past Singapore, past Malaysia, over to India, and it's Indo-Pacific. That's something a bit new.
Futures on the S&P up about 1%, on the Nasdaq 100 up by 1.34%. A brutal year so far. A man who's a little bit more constructive than most, Jonathan Gollop of Credit Suisse. He joins us very shortly on this program. For our audience worldwide, heard on radio, seen on TV, this is Bloomberg Surveillance.
The Indian city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
The latest note out of Bank of America and Mr. Michael Hartnett. he would sell any rips, even though he acknowledges this market is very, very vulnerable to a bear market rally. Futures are positive by about 1% on the S&P, on the Nasdaq by 1.36 on the week. We're heading south again. 7 straight weeks of losses. We keep going over this, the longest weekly losing streak going all the way back to 2001. Something has changed though in the bond market. We'll do that briefly. Equities and bonds, the inverse correlation, it sticks again this week. It happened last week. Yields were lower on a 10-year by about 21 basis points. They're lower this week as well by 5 or 6. On a session though, we head higher by 2 or 3 to 286.41. That's your 10-year, your 2-year right now, up a couple of basis points as well, 262.65. Yields with just a little bit of a lift. That's your cross-asset price action. Let's get you some movers. We can check in with Romain Bostic for more. Good morning, Romain.
Hey, good morning, John. We talk about some of those tech stocks and investor sentiment out there. The good news is that some of those tech stocks are getting bid today. Some of them on the back of fundamentals, including Palo Alto Networks. Those shares higher by more than 12% here in the pre-market after a beat and raise quarter. And then you have Apple higher by about 1.5% pre-market here. No real reason other than maybe just buying into those dips here, but a little bit of caution here, even with that 1.5% rise here in the pre-market. Apple setting up for what's going to be its 8th straight weekly decline, a streak that we haven't seen going back to 2018 here. Dan Ives out here kind of defending the position here, not only reiterating his outperform rating, but kind of making the case here that a lot of babies are being thrown out with the bathwater. Unfortunately, I'm not really sure that matters right now. Investor sentiment really is driving this market, and it remains dour despite some of the green you see on your screen. Deere is sort of emblematic of that. Those shares down 4% here in the pre-market despite a beat and raise quarter. Just a few minutes ago here, those shares right now camped out at around 348. I would keep an eye on names like that and keep an eye on the retailers, of course, which have been all over the map all week long. Ross Stores did come out with their earnings. Same issues that we've heard with Walmart, Target, and some of the other big retailers out there. They're actually seeing pretty decent foot traffic, but the inflationary pressures are just too much. Ross Stores shares down 27%. They talked a lot about actually raising prices in the most recent quarter, but basically admitted they weren't able to raise them enough, primarily because, well, they're a low price retailer and there's only so much you can do, so much you can pass on to the consumer. Burlington Stores down about 10%, which also competes in that same space. Also seeing pressure on Kohl's, TJX, and a few other names that are sort of at the bottom rung, if you will, of that retail spectrum. All told, what you're looking at on your screen here right now with regards to the retail stocks, that's really driving sentiment right now, and I would keep an eye on them as we get deeper into the day. Tom.
Romain Bostic, thank you so much. Of course, wrapping up the week, the close, look for that Friday afternoon. That's on after the real yield. We'll be looking for that as well. Right now, and this is critically important with 2020 hindsight, to look back at somebody who nailed the last great moment of the bull market. John Golub in Credit Suisse had the courage to come out with a barbell strategy, which was blah, 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 and don't give up on the big techs. He was a genius. The genius joins us this morning. John Golub is head of U.S. equity strategy and quantitative research for Credit Suisse. Now what, John? If I have Amazon, Apple, whatever, and I'm going to hold them, what is the prescription to recover?
You know, Tom, we actually think that in a high inflation environment, that tech just doesn't do as well. So it's interesting. We've been table pounding on tech throughout the last couple of years, but as we rolled into this year, we didn't say short them. We said basically good and neutral, because as long as the cycle continues to be inflationary, they just struggle a little bit more. And what we actually see, and we've done a whole bunch of quant work around this, is that when inflation is high and stubbornly high, you actually want to be in stuff that's more cyclical, beneficiaries of this. So energy stocks, material stocks, and the like. Not because these are the best stocks forever, but they're the best stocks for the moment.
Will those tech stocks continue to have revenue growth?
Yeah, but if you take a look, like in the last, let's say the most recent earnings season, tech names, grew about 7%, but those cyclical groups grew something like 30 or 40% because they just did better. They have more operating leverage, more physical infrastructure in the kind of old economy cyclicals, and therefore they have more upside. And if you look at this earnings season, those tech companies were, the mega cap tech companies were pretty lackluster. So it's not just a sentiment issue. They're having a harder time, but also they went into the year very expensive. That run that we were predicting in tech played out beautifully, and sometimes you have to know when it's time to take your foot off the pedal, which is what we did on tech earlier this year.
How do retail earnings fit into your thesis?
Well, Lisa, I think that everybody, starting really last Friday, thought that the worst was behind us. And then with, Walmart and Target news, people felt like they got kicked in the stomach, that maybe the consumer is rolling over and companies are going to have margin problems. And then if you actually look, we had a lot of companies like, TJ Maxx and Home Depot and Lowe's, and they did fine. They had beats in the high single digits. It was really a couple of these prominent names like Home Depot and Lowe's had a harder time. And a lot of those were really what I would call is a mix issue. People were buying groceries, but they didn't want to buy furniture and TV sets. And in many cases, these were really merchandising problems. They were kind of the wrong products as people are rotating towards experiences in restaurants and hotels and getting back out. So I'm not sure that we should be over extrapolating some of the bad news from those retailers. But I will tell you, it surely shook the market in the middle part of this week.
So that's the glass half full view of these retail earnings, that basically it is a mix issue, not a consumer health issue. And some people would agree with you, Jonathan, but doesn't that give you a sense that the Fed is going to raise rates all the more so to try to stave off some of the inflationary pressure, because the consumer still has momentum, and that presents a valuation problem for stocks, as we were hearing from Savita Subramanian of Bank of America earlier this morning?
Yeah, I'm not sure that the Fed responds to the retail earnings, but I mean
generally the trend.
But listen, wage inflation is really high. When a year ago, when we had 3% inflation, people were saying that's peaking. There's no way it could get to 4%, and now we're over 8%. So the Fed, I don't want to say they're on autopilot for a little while, but they're going to have to push rates, at least to 3%, which is what the market's discounting. And my view is by the end of next year, we may be closer to 4% on Fed funds if they need to, really,
But hold on a second, Jonathan. In all honesty, then, how can stocks keep rallying? How can you get to near 5,000 by the end of the year on the S&P if you get a 3 or 4% Fed funds rate?
Well, the most important thing is corporate profits are holding up really well. And so take a look at this earnings season. Revenues are running on the S&P 14% this quarter. Earnings are up 12%. So the margin pressure is tiny. But we had this really weird thing going on with the banks, with reserve releases. And if you took that out, the revenues were 15% and the EPS was 20%. So the earnings are super powerful, and stocks are cheap at this point.
John, that is the most intelligent thing I've heard this week on equity optimism. That differential equation is linked at the hip with nominal GDP and the decline. Are you suggesting, within all the Credit Suisse work, that the great miss here is that nominal GDP will sustain longer, which will allow companies to adapt into the gloom Lisa just mentioned?
Tom, I think that is the only story. My favorite, the one screen that I look at the most on my Bloomberg terminal is ECFC. Where is the consensus view on what the economy is going to do over the next quarter and year and 2 years? And what it tells you is that nominal GDP this year should run at 9%. Normal is 3.5%. For all of those folks who say, we're going into recession, economists all over are basically saying this is a rip-roaring economy.
I'm going to tear up here, John. John Golub has really drunk the Kool-Aid at Credit Suisse, Donaldson, Lufkin, Genret. He's on the edge of Tom Galvin here with a sales-centric view.
I'm going to try and be polite here. ECFC, okay. John, has that ever been a leading indicator for anything?
Well, Jonathan, you have to use some framework to say directionally, where do we think that the economy is going? So if you're looking at, where inflation is going, you can look at the TIPS market. If you're looking where GDP is, there's no tradable instrument on your Bloomberg. You have no choice but to use either your own house economists, and our economists guys are also pretty bullish, or you could just say, where's the whole gang thinking that the growth is going to be, And that's what you find on the terminal. And not only can you do it, but I can see it by firm. So I can say, what are the biggest shops? What do the people at the Fed think it's going to be? They're all in the same direction, which is the underlying economic growth measured in nominal dollars, that's including inflation, is going to be really strong this year. And here's the most important thing, and really strong next year as well. That's
I'm with you,
that's
John.
not Gollum's view. That's
No,
what,
I hear all that. I hear all that. It's just the Fed forecast. John, when did the Fed ever forecast a recession? I mean, it's just not. It's not in their business, is it?
They do it about a year with a year delay. You know, they do it after the fact. But listen, I get that, but you have to use some framework to saying, where do you think the world is going? If you ask me what the most important issue is on inflation and growth, we have an incredibly tight labor market, which is leaving the consumer really confident in their ability to find work. And that leads people to be willing to go out and overextend themselves on credit. And it also means that you have high wage inflation. You add those two things together, it's all about the labor market. And that's my take, independent of what you have on that forecasting screen.
A defiant bull. John, it's going to catch up, buddy, as always. Jonathan Golub there of Credit Suisse. Bram, I will give John this. That retail story this week, far more nuanced than first look.
Absolutely, especially because of Home Depot, and to a lesser extent Lowe's, as he was saying. That said, there clearly is a margin issue that we have to get our hands around and understand.
I like the ECFC function. It's not, I've not got a problem with the function. Just, I'm not sure what it forecasts and how accurate that's been over the years. Futures on the S&P up a little more than 1%. From New York, this is Bloomberg.
Keeping you up to date with news from around the world. With the first word, I'm Ritika Gupta. President Biden arrived in South Korea and immediately underscored the importance of resolving the global semiconductor shortage. The president toured a Samsung chip factory that is the model for one the company plans to build in Texas. The White House says the Texas plant will mean good-paying jobs and more resilience in the supply chain. Meanwhile, Bloomberg's learned that President Biden is considering a meeting with Saudi Arabia's Mohammed bin Salman as soon as next month. That would mark a shift for the president. He has avoided contact with the Crown Prince over the murder of journalist Jamal Khashoggi. PIMCO and BlackRock are amongst the firms set to start debt talks with Sri Lanka soon. Bloomberg's learned that Alliance, Bernstein, T. Rowe Price and Wellington are also amongst the members of a creditors group. Sri Lanka fell into default this week for the first time in its history. An economic meltdown has led to protests and a political crisis. And the largest maker of agricultural machinery, Deere, reported quarterly sales that were below estimates. The company says that higher costs had an impact on farmers. Disruptions related to the invasion of Ukraine helped elevate prices of fuel and feedstock. That could lead to farmers to put off investments in machinery. And SpaceX reportedly paid $250,000 to settle an employee's claim that she was sexually harassed by Elon Musk. According to the online news site Insider, the rocket launch company made the payment to a flight attendant who worked as a contract employee on the SpaceX corporate jet. Musk, who's the founder and CEO of the company, calls the accusations utterly untrue. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
What we're seeing in the markets is a rotation from growth stocks with earnings very far in the future towards stocks that are much more value stocks, earnings here in the present. And this reflects the fact that real rates, for the first time in a very long time, are likely to go positive in 2023.
Great conversation with Ken Griffin of Citadel there, alongside Francine Lacquet yesterday here in New York City. From New York, good morning to you. Futures are positive by a little more than 1% on the S&P, on the NASDAQ 100 by 1.5. Yields traveling north, heading up higher by 3 basis points, 286.95. And the euro just a little bit negative, backing away from 106, Tom, 105.75.
It's going to be interesting. What do you think of Ken Griffin's comments, John? I didn't see them all, but I know you were studying it carefully. Did we learn anything?
He had something interesting to say about retail traders and Wall Street bets going after a certain hedge fund.
Yeah.
And how that wasn't nice because it was about going after teachers' pensions, which
lit up Twitter.
I have to say, I didn't really fully resonate with me, Tom.
You're so political. Thank you to Francine Lacquet for bringing up that third rail of sensitivity.
It's a great interview just to probe like that and just to get him to go deeper on it. I thought you did a brilliant job.
I'm going to stay out of it, as is Mr. Farrow, because we'd like to work Monday. Right now, and this is really important, a gentle lady from the Massachusetts Institute of Technology is with us, Katie Kaminsky, is Chief Research Strategist of Alpha Simplex, and she and I are going to drag ourselves back in years to what mattered the last time commodities really lifted. Katie Kaminsky, you and I are not going to turn this into a nerd fest, but let's be honest. The reason the commodity game exists, as John Farrow mentioned, copper staggering a little bit here, is commodities trend like nothing else. Are commodities going to trend into 2023 where I could find alpha?
I would have to agree, yes. And let me give you a couple of pointers for this. Please. Inflation, first of all, is something that's very positive for commodity returns. Investors have forgotten about commodities because they haven't worked in a low inflation environment. Now, let's take oil as an example. Oil prices have remained high despite some very, very negative things like a strong dollar, weakening demand in China, but yet we're still at pretty high oil prices. So what that tells me is there's still very much a commodity story that's left. And I think investors have forgotten about the value of commodities in a low inflation environment.
I'm going to go back to Tusha Shandy and a lot of the people that invented this and the whole CTA, Ballet, Monroe Trout, and all. Do you buy individual commodities as Pharaoh does? Folks, you should see Pharaoh on commercial break. He's over at the LME looking at aluminum and the whole thing. Do you buy individual commodities or do you buy a modern manufactured index or ETF?
Well, this is a good question because different commodities. Yeah, different commodities react differently to different environments. And so let's take last year or during COVID, we saw a very different move in energies than we saw in the precious metal basket. So certain commodities are more linked to inflation and then are affected by different supply and demand cycles. So thus, you should really think a little bit about what you're buying, what it's linked to, what type of cycles are going on in the markets, and which ones might be favorable given the current macro conditions. I'm always a big fan also of thinking about long and short. The reason for this is that over the long term, statistically, long and short indices and strategies and commodities have done better than long only, but I still suggest that you can add some long only exposure during certain cycles, which might actually help offset some of these really difficult moves we've seen in equities and bonds.
Well, Katie, that's exactly where I wanted to go, that we're talking about the move in commodities and betting on potential commodity producers and the like at a time when nothing else is working. Is commodities still the only bright spot, or do you see some of the other pockets starting to work again, like bonds?
Yes, the interesting thing about that connection, if you look back in the 70s, and I know it's a long time ago, it seems, but we had a very, okay, sorry about that. It's an interesting period to compare with because in that environment, we saw increased commodity prices. We saw bond and stock volatility being higher. Does that sound like what we've seen this month? And secondly, we saw positive correlation between stocks and bonds on occasion. Plus, we also saw commodities occasionally having different correlations with equities. And that is sounding like this month and this year. And so what that tells me is that there's going to be time varying interesting opportunities. I just say that for now, I'd stay away from long bonds as you wait for rates to rise. But there could be some opportunities eventually as we see more yield. But commodities is still really the asset that's going to move the most with inflation and that has the highest potential to provide some offsetting return to what is a very challenging market environment.
Katie, what would you say to the Jonathan Gollops of the world who say that people have gotten way too bearish on stocks because, frankly, on a nominal basis, you get growth. On a nominal basis, you get revenues. On a nominal basis, a lot of these companies also provide an inflation hedge.
That's good as a point, but that's not a short-term view. I think the problem is we have to navigate the next few months. We need to navigate the rising rate environment. And so I think, even for bond investors, yeah, bonds give you a positive yield over time, but when yields are going up, it hurts. And so I think the point is he's right that you want to hold stocks over the long run, but you could also try and find ways to protect your portfolio in the short run as inflation and rising rates and growth destruction are a real challenge in a more uncertain environment.
Katie, thank you. As always, wonderful to hear from you. Katie Kaminsky there of Alpha Simplex. Lisa, I can find a lot of people who are bullish into year end. I can find very few who are bullish into the end of this summer. I can hardly find any.
Yeah, although if you look 6 months after that, they start to get a little more bullish, which raises an interesting question. What actually triggers that, right? What triggers that capitulation? Right now, there's so much pessimism based on this idea that the Fed is hiking into weakness, right? We talk about it with the ECB, but that essentially is what the Fed is committing to. How do they deal with it at a time when valuations still are stretched, at least in certain areas that people point to?
You know what the hope is? We get a few more months of inflation data. Hopefully it's convincing enough that we're on the right trend, with inflation coming in lower, and then we get to the end of summer and the Fed backs away, Tom. What backing away actually means, I'm going to find interesting. Is it 25 basis point hikes? Is it a pause? What is backing away?
Again, it's nonlinear, John. And let me get this calendar up here. I'm distracted by that wonderful trend-based discussion on commodities. Sorry, John. What are
you looking for?
Did you pay for my terminal this week?
It's paid for.
Okay, June 15th is a meeting. That's huge. And wrapped around the ECB meeting as well. Those are really non-analyzable. They're there, fine, whatever they do. I'm sorry, July 27, September 21, November 2nd, massively data dependent, massively nonlinear effects.
September. Lisa, that's the one to look for, and I would say Jackson Hole ahead of that in August.
I was actually just talking about Jackson Hole last night with someone, talking about how they're going to position, given the fact that they're going to get that data, right? How can they say they're data dependent continually if the data is in and it shows a very decisive trend?
I think based on the data of the last 12 months, I don't think anyone can say this Fed's been data dependent. I don't know why we keep doing this. Go on, Tom.
The biggest problem that we've got is at the Pioneer Grill at Jackson Hole Lodge, they don't do a full English. They do a full Wyoming. It's a bigger breakfast.
Is it a better breakfast?
It's not better. It's a bigger breakfast.
Is it better?
It's full. I can see you there in a cowboy hat with the leathers on and the Tony Lama two-tones.
I don't know about the leathers.
Pioneer Grill, John Farrow.
I'll do my best to get there.
Okay, guys, as you can see, position opened on Japanese yen. Well done. All of you guys who decided to trade Japanese yen, we opened short position. So stay with me and we'll close this trade in profit. I'll speak to you later.
It's almost the end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada, 1-2 itu ada. Tapi nggak kayak dulu, kalau dulu rame sekali. Sekarang paling dapat jualan ya 100, 120 gitu, 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 itu nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu. Sama aja, belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
The risk right now is that when we look at equities so far, the de-rating that has happened was purely really a function of valuations.
Expensive companies were extremely expensive, and that's where all the pain has been.
Financial markets have a really tough time discounting things that are likely to happen or may happen in the distant future.
This delicate balancing act is what the Fed's got to navigate, what all central bankers have to navigate.
We have to wait a little bit to see if what the Fed is doing is the right thing.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on a Friday. An exhausting week, setting up for weekend reading, and then we will be in Davos, Switzerland next week. John Farrow, the tumult of the week, a better tape this morning.
This morning, but not on the week. 7 weeks of losses. That's what we're set for. On the session, up by about 1%. And the question I keep hearing asked repeatedly, have we seen the capitulation? Bank of America say this. Real capitulation is Fed capitulation. It's a systemic event. It's unemployment rising. That's what's required first, at least in the view of Michael Hartnett over at B of A.
The important reading for the weekend from Hartnett. And John, what's so important there is that's linking in the economics with the market performance. But even looking at the market, John, we can't talk about capitulation with a VIX at 28.62. We're miles away.
People waiting for something north of 30, Tom, approaching 40. Here's my thing, TK. This week, people were really spooked by those target numbers, not because it was surprising, but because the market was so surprised by them. Just in terms of the reaction, to see a stock down close to 25% just like that, TK, off the back of a story we all thought we really understood and also thought was increasingly well priced. I think that was a shock for some people to find out that maybe it wasn't.
There are tea leaves out there, John, like Pakistan rupee, Turkish lira, and the rest. But the really underpinning here to the lack of capitulation is resilient dollar and somewhat of a quiescent bond market within the new bond volatility.
The biggest story, Tom, and I think it's going to resonate with people far outside Wall Street, we have a cost of living crisis around the world. Growth is heading in the wrong direction. Inflation is heading in the wrong direction. We haven't experienced that in the developed world for a long, long time. Not at this level, not as broad as this. And for the Europeans, I think that's the one to watch because they're right at the leading edge of all of this. Do they have to hike into a weaker economy? That's why for me at the next meeting, the ECB June 9th, there's a lot of pressure on President Lagarde to find the right path forward, and I'm not sure there is one.
And Lisa, I'm glad that John mentions this because I've been remiss on this today and frankly through the week as well. 9% is my statistic of the week. Maybe it's on the edge of double-digit inflation in the United Kingdom. Difficult German production inflation data today out of Germany. We're almost becoming used to it. We're rationalizing high inflation in America.
And 1970s continues to be the benchmark, not necessarily saying we're seeing a repeat of the 1970s, but today, the UK consumer confidence read came out at the lowest levels going back to the 1970s just because of that dynamic that John and you are both talking about. How much do we see this paint a similar picture in the United States, right? Or how much is it a distinction that we see with momentum that people keep talking about that distinguishes the U.S. from other nations?
John, for the first time since time began, I'm almost on the same page with Klaus Schwab of Davos. I've been a critic of their themes and how far they are behind.
I've got to laugh through that, Tom. You're on the same page as Klaus.
No, I'm not on the same page as Klaus, but Dr. Schwab is saying history at a turning point. And for me, my phrase, my theme for this Davos is Davos and the end of the holiday from history. The holiday from history is so over. And John, this is underplayed this week because Ukraine is such a grind right now. This news in international relations folds into our markets.
Tom, I won't be at this event. I just wonder from your perspective, historically, you and I have been there a lot together. It's usually completely divorced from reality.
Yes.
You sense next week will be different.
I sense that about every 7 years, Davos is overtaken by the news flow. Why wouldn't that be this time around, where all the certitude and belief is out there and themes and all the mumbo jumbo, and it's just swept away by the news flow.
Looking forward to your coverage, Tom, through next week. Futures positive on the S&P by a little more than 1%. On the NASDAQ 100 up by 1.5%. Yields are higher by about 3 basis points on a 10-year, 286.77. Bit of quiet out there. Some welcome quiet, some peace and quiet for now at least. Futures positive, Tom. Largely boosted a little bit, at least, by what happened with China. Chinese banks cutting rates.
Let's jump into it right now. The gentleman who knows the Cubs are behind the mark here in April and into May, and maybe we'll look forward not to Cubs baseball, but maybe what our Federal Reserve System will do. James Bianco is founder and president of Bianco Research. Jim, what are you going to write about this weekend?
About the economy, I think, in that there is a fundamental shift going on. It's probably the biggest story that no one talks about, is this whole work from home phenomenon is something real, and it's something that's going to last. A recent study said that only 8% of the offices in Manhattan are back to full time. Everybody else is either work from home or hybrid. I think it was behind the target numbers too. They've got an inventory build on a lot of stuff people don't want, because when you've shifted your patterns of work and home, you shift your consumption basket. And I don't think we're ready to acknowledge that that's happening. And that's keeping the economy offsides, and that's keeping a friction in the economy and inflation higher than it would otherwise be.
So, Jim, what does that tell you about this week? Does that highlight the struggle the C-suite is having navigating this economy, one? Or two, does it signal a weakening of the economy? Because we traded on the latter, really, not so much on the former.
Yeah, we are trading on a weakening of the economy. And you've also seen it, say, in things like the Bank of America survey, where all of a sudden tightening monetary policy and global recession have surpassed inflation as the #1 tail risk for the first time in many months. And everybody is now worried about a global slowdown. I am too. But then they come to the conclusion that the Federal Reserve and other central banks are going to have to pause or pull back on their tightening after some round of initial tightening, say in the June meeting and maybe in the July meeting. And I don't see that. I see the central banks as being committed to trying to rein in inflation. And if you want to put it in market parlance, the Fed put is about unemployment and the inflation statistics. It's not about what level of the S&P do they change at. It's at what level does inflation have to come down to, or maybe unemployment have to rise. And I don't think a lot of people are, at least on Wall Street, ready to accept that as an answer. They think the Fed's going to stop because they're having a lot of pain. But a lot of people that have to live on a fixed income, that's who the Fed is focused on.
Jim, translate your view into a market call where a lot of people are saying buy the dip in bonds, and they're seeing a peak in yields exactly because of what you're saying, because they do believe that central banks will pause, that we will get inflation under control still, and that we can move along back to some sort of normal that we remember. What's your view on that?
You know, it's possible that we saw the high last week at 320 on the 10-year note, but I would probably bet not. What I think we're seeing now is a flight to quality. The stock market has been so volatile as of late that it's really trading, the bond and the stock market are trading as one. If you see a serious rebound in the stock market, you know, you're right, we're about to have the 7th down week in a row. If we actually had 2 up weeks in a row and you didn't see bonds make a run back at 320, then you'd have a chance of saying that we've seen the high. But I have a feeling that once the stock market finds its sea legs and then attempts a retracement rally, the yields are just going to go right back up again. So I understand the argument for 320, 10-year being the high of the year. I'm just not sold on it yet.
So where do you think we really see that capitulation? Can you elaborate a little bit more about the balance of buyers of some of these bonds and what people might not be understanding fully?
Well, there's been, at least in the statistics, not a whole lot of capitulation. If you look at the future statistics or the surveys of managers, there's nothing there that suggests that we've ever gotten to an extreme short or underweight position to begin with. So it's been a year of real pain for fixed income managers. I suspect that they're still holding out hope that the slowness in the economy will get the Fed to stop, and that's why they're trying to make the case for a turnaround and a rally in bonds. But I still think that the capitulation is to come. One other thing, whenever you've seen throughout the last 50 years, whenever you've seen yields go up this much or total returns in the bond market, that's including price, fall this much, I always like to say that the bond market doesn't peak in yields until something changes. So it's usually bond yields go up a lot and something big happened, like a recession or like a financial crisis, or a serious slowdown in the economy at a minimum, and then that was the peak in yields. If last Tuesday was the high in yields, you'd say we had one of the biggest rises in yields or biggest declines in total return, And then some random Tuesday they peaked and that was the end of it. I'm not so sure that that's going to be the case this time.
Hey, Jim, awesome to hear from you, buddy. Thank you. Jim Bianco there of Bianco Research. Some of this has been pretty random. Talked to a lot of people in fixed income about this. On any given day, you can have a move of 10, 15 basis points in either direction in the Treasury market, Tom, on any given day without much of a catalyst.
Well, yeah, look, I mentioned this earlier. I thought Michael Collins was just brilliant with PGIM. I think there's the verbal, John, of a bond bear market is radically different than the verbal of an equity bear market. And the magnitude of this drop in price, this is all new. I mean, people are making it up in bonds, not as they go, but literally hour by hour. It's
Tom,
serious.
To that point, and you can speak to this, we've seen a lot of corrections over the last few decades. We've seen a few bear markets along the way. How many people can say they experienced a bond bear market? Very few. Very few can actually say they've worked through that.
Back to the 70s. You do a log chart of the Bloomberg Total Return Index, pick the credit level, John, I don't care. And the answer is this is very 78, 79, and into Paul Volcker. I mean,
You said it. It's very 70s. Bramo
Late
Tibbin,
70s is a difference.
Okay.
No, there's a difference. It was before K-pop.
I think, though, there is a larger point here about liquidity and the issue of just the incredible swings that you're seeing and the lack of conviction and where that stability comes from. This is supposed to be the deepest market, most liquid bond market in the world. What happened to that liquidity?
Mohammed Al-Erin has been saying the same thing repeatedly over the last few months. Futures are positive by about 1% on the S&P, on the NASDAQ up by 1.5%. From New York City, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. President Biden arrived in South Korea and immediately underscored the importance of resolving the global semiconductor shortage. The president toured a Samsung chip factory that is the model for the company that plans to build in Texas. The White House says the Texas plant will mean good paying jobs and more resilience in the supply chain. More aid is on the way to Ukraine. Group of 7 finance ministers meeting in Germany are set to agree on more than $19 billion for Ukraine to guarantee the short-term finances of its government. That's according to Germany's finance minister. Meanwhile, the U.S. Senate has passed an aid package for Ukraine worth more than $40 billion and sent it to President Biden for his signature. And the administration said it was providing Ukraine with another $100 million in military assistance. Finland is becoming the 3rd European country to be cut off from Russian and natural gas. Like Poland and Bulgaria, Finland is refusing to pay for the fuel in rubles. The lost supplies will probably have a limited impact on the Finnish economy, though. Russian gas just accounts for about 5% of the country's energy mix. And in China, banks have taken a step aimed at boosting the ailing economy. They cut a key interest rate for long-term loans by a record amount. Lowering the 5-year loan prime rate would reduce mortgage costs, and it may help counter some weak loan demand caused by a property slump and, of course, those COVID lockdowns. And another roadblock for Boeing, which is trying to get airlines in China to resume flying the 737 MAX. China Eastern Airlines has outlined several actions it needs to take before operating the MAX again. Amongst them, more pilot training.
Hello, traders again. It's time to place stop loss for our Japanese yen position. Okay, I'm going to place stop at 128.35. Okay, 128.35. Stop loss placed. So anything, whatever happened with Japanese yen, we're already in profit. And what else I want to say? I probably will move even. No, not right now. Probably in a couple of minutes, I will see. Probably I will increase my stop for Japanese yen. Let's see what's going to happen with this pair. Okay. No, I still keep this at this level. Okay, we have 2 pips. It means we have 200 pounds in profit. So stay with me. Please place your stop. Don't be a hero. Please make profit for if it will move to different direction. And if not, we will increase our profit to another level. And I'll speak to you in a couple of minutes. We will see later on. I'll speak to you and let you know how far we're going to increase our stop loss. Okay? I'll speak to you later, guys.
Validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management. It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
It is inflation. In the short term, it is inflation. In the long term, we need sustainable growth for all of our economies. We have to rehabilitate growth in a sustainable, inclusive way. It is for all G7 member states, all G7 countries, a key priority.
Okay, guys, we will put place stop loss even to better level. So I'm going to place stop at 127,995. Okay, so 127,995. It will give us £500 in profit. Please change your stop to this level and stay with me. I'll speak to you later.
And industrial strategy. He, John, and the rest of the nation enjoying a 9% inflation. Kwasi Kwarteng is with us. He's celebrating Liverpool's European dominance and more than anything understands the gridlock of British politics. Author a decade ago of Gridlock Nation. What's the level of gridlock right now, Minister, in terms of dealing with 9% inflation?
Well, it's a huge challenge, Tom, and you will know that it's a global challenge. We had a pandemic, we had lockdowns right across the world. We had a huge surge in demand when those lockdowns were eased. And now we've got this unprecedented situation in Ukraine, first time in 70 years, 75 years, that we're seeing an actual war in Europe. So these are unprecedented times. And the British government has very much decided to help consumers, help people in the UK. We had a good announcement from the Chancellor in February about the kind of help that he was willing to give. And he and the Prime Minister have said that they are looking to help people more.
Let's talk about that and whether the consumer, the people of the UK are feeling that right now. Kwasi, you wrote a letter recently to petrol retailers about the concerns that the Chancellor's 5p fuel duty cut wasn't being passed on in any visible or meaningful way. What's the response been?
Well, we're looking at that still. I mean, I think it's very wrong of petrol, the forecourts, not to pass on the reduction. And I think, you know, we're seeing that there's some behaviour change, but there's a lot more they could do. And I'm very keen that they actually help out.
And yet you're against the windfall tax. Why is that?
I've been always against windfall tax. I think they're arbitrary. I think they discourage investment. And when you look at the companies that invest in the North Sea, you know, it's a very cyclical business. So when they make money, they tend to make a lot of money, and then when they lose, they make big losses, and they're not supported when they do make those losses.
You've talked about investment in the UK, and you're worried that it would deter investment. Bernard Looney of BP said to the Times earlier this month, he was asked basically whether he'd change any spending plans because of a windfall tax, and he said, quote, "There are none that we wouldn't do." Isn't that good news? That you can do this, that he won't change his spending plans. He's telling you.
Well, it's up to I mean, you can speak to Bernard directly yourself. I'm not quite sure what he was referring to, but there's no doubt that other players in the industry say that any kind of windfall tax would deter future investment. I mean, that's pretty obvious. And they need fiscal certainty. They don't want rabbits out of the hat, so to speak.
Well, BP's telling us the opposite. I just wanted to jump in with something the Chancellor said too. The Chancellor said, what I want to see is significant investment back into the UK economy to support jobs, to support energy security, and I want to see that soon. If that doesn't happen, then no options are off the table. Now, as you know, Kwasi, the prudent response from any Chancellor is not to take things off the table ahead of a budget.
Exactly right.
But I want your view on that. I want some goals. I want to understand what kind of investments you want to see from these players and over what time frame, because if we're going to wait for these guys, they've got a 10-year time horizon for their spending plans. We'll be out a decade and then we'll say, oh, okay, maybe we should do a windfall tax now. What's the time frame? How much spending do you want to see over what time?
We want to see spending. I'm not going to quantify it, but we want to see actual real spending. And there's evidence that they're doing that. I mean, if you look at our program for carbon capture, blue hydrogen production, both Shell and BP are directly involved in that in the northeast of our country, of England. And they can see that there is a huge opportunity in terms of green investment, and that's exactly what the Chancellor, the kind of investment the Chancellor wants to see. And as you say, the Chancellor's quite right to say all options are on the table. Every Chancellor I've known since I've been an MP has always said that. There's no way that he's going to take options off the table ahead of the budget.
Dr. Courtine, you enjoy a PhD in economic history from a small shop, the University of Cambridge. You know the history of this, and the simple history is windfall profit taxes do not work, period. It's well documented. But as John alludes to, there is a generational trust that has been broken between corporate elites and the people. How do you guarantee, given the lack of trust, a process here that helps the people of the United Kingdom?
So that's why the Chancellor was very clear, Tom, that they have to invest in the UK. We want to see their ambitions realised by their investment.
Do you need it in writing? Is it so urgent that it needs to be codified, to be in writing?
I think the commitments are already there. I'm not sure that we need any kind of legal document or quasi-legal document. But what they understand is that these new technologies, the decarbonisation, all of that stuff needs investment, and it actually creates jobs. And you will also know that we're very interested, very focused on levelling up. That's actually giving opportunity to areas of our country in the UK, which in the last few years, few decades, have been underinvested. And so BP and Shell and others know that our commitment to levelling up and our commitment also to decarbonisation mean that business investment needs to happen, and they're very aware of that. And they also know, as the Chancellor said, that if they don't step up to that plate, then they could well be subject to a windfall tax. I think that's a reasonable conversation.
Just a final question, sir. Just on the final point, to understand what people are going through right now, if they listen to this conversation, you've got a company, BP, engaged in buybacks. I'm not here to say that's the wrong thing. They've referred to themselves.
Are you ready to trade Bitcoin? I'm going to place order to buy Bitcoin, at it will be close one to actual price at 30,265. Let me, I'll check if I will be able right now. Okay, the order I'm going to place 30,265. Okay, 265. Now let me place. If you want to trade Bitcoin, please do so. 30,265. This is the price I'm looking to buy Bitcoin. Okay, guys, it's very close. So make sure you will be able. If not, you can buy at lower level. Okay, guys, and okay, position opened on Bitcoin. Stay with me and we will trade together. I'll speak to you later.
Business. TK, what a difficult moment for a lot of people.
It's not only a conversation in the United Kingdom. I think you're going to get a repeat of that, rinse and repeat here in America in months.
Live from New York City for our audience worldwide on TV and radio, this is Bloomberg.
Nuestro estudio, nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes. Según las modelizaciones, nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes.
Okay, traders, I'm going to place stop loss for Japanese yen. Please copy this stop and place stop at 127. 55. Okay, 127, 955. It will give us 1,000 pounds in profit. That's a good trade right now for you guys. If you want to trade other pairs, because we're very busy during the day, we trade all securities, derivatives. You can see on the screen only 6 pairs, actually 5 pairs and Bitcoin. If you want to trade other pairs, please get the strategy. You can get the strategy and you can find out how we trade. And also you can start trading other securities that not available, that not you can visible on our screen. Okay, guys, stay safe.
Live from New York City this morning. Good morning on TV and radio for our audience worldwide. We have a little bit of a pop, a bounce, a rally, whatever you want to call it. We're positive on the S&P, up by a little more than 1%. On the Nasdaq, up by 1.5%. Yields unchanged now on a 10-year, 283.70. Unchanged on the session, down on the week for a second straight week. Equities, unfortunately for many of you, down on the week as well for a 7th straight week. TK, it has been pretty ugly out there over the last 2 months.
Almost as ugly as in Liverpool. Right now, John Riding joining us here, Chief Economic Advisor at Green Capital. But on a Friday before the close of Premier League football, Lisa and I opened this up for full discussion with a gentleman of Preston North End and young Farrow as well. John Farrow, the only player I remember from my youth was Gerrard.
Oh, you love him, don't you?
I don't understand why I loved him, but I loved him. And I want you and Riding to talk right now about Sunday and for America, why Steve Gerrard really matters.
There's a great subplot to the story on Sunday. So on Sunday, you've got Manchester City top of the league of the Premier League. You've got Liverpool second. Manchester City win, it's all over. But Manchester City, John Riding, are playing Aston Villa, and Aston Villa are coached by Stevie G, the former great captain of Liverpool. That is a nice little subplot going into Sunday's games.
Yeah, and add to the fact that two of the key players for Aston Villa are former Liverpool players in Danny Ings and in Philippe Coutinho, who were arrested against Wolverhampton against Burnley yesterday, and you've got a potential chance for those two. If they hold City, they'll deserve winners' medals from Liverpool.
That is a big game, Tom, not just for Manchester City and Liverpool, but for some of those people at Aston Villa as well. So lining things up on Sunday, Tom, I'll talk Eastern time, 11 Eastern, all the games all at once, the final games of the year, all played simultaneously. It is great to see.
Lisa, is there a soccer bar in Davos? I mean, is this what
I'm sure you'll find one,
Sunday?
Tom.
Oh, the Bramo camcorder not paying attention.
Just leave me out of this one. I'm good. I wanted to talk about John Riding's experience at the Atlanta Fed, and I wanted to actually
talk about Liverpool and Preston.
I know.
North
well,
End.
Fine, John, but I want to talk about the Fed. So bear with me. Let me just take a quick move over there, and then you guys can all talk about football.
Thank you.
And I will let you go to the pub together on it. I am curious, though, especially after being at the Atlanta Fed confab just recently, there seems to be a belief in markets that the Fed is going to recognize the slowdown that we're seeing in some of the data and respond by pausing, by not raising rates as much. That seems to be opposite the rhetoric from Fed officials. What was the scuttlebutt when people were talking to you, when they were not on camera, when they were not on the podia? What did they say when it came to their frustration with markets and their belief in a Fed put?
Well, what's remarkable is Fed officials don't pay anywhere near as much attention to the markets as we do on a day-to-day, sadly, minute-to-minute basis. And you have to think, where were the markets? In the fourth quarter of last year, before the Fed had made its pivot, they were seeing very little interest rate action from the Fed this year. And then they overshot Fed guidance this year to get into the point where it was almost half a point at every meeting. And now markets are pulling back a bit. I think the Fed's looking, they've laid out the game plan. We want to get some rate hikes underneath our belt, and we're going to get 50 basis points done in June, 50 basis points done in July. That takes you to the September meeting, and that is really the key meeting for, I think, for where short-term interest rates are going, because it's all about inflation persistence at that point. And if inflation has ebbed sufficiently, then they're going to look for an opportunity to dial back, I think, on the rate hikes and slow to quarter-point rate hikes. But the experience that people have had with the Fed for the last 20 years or so will not particularly help them guide the Fed, because it's different, because we've got late 70s, early 80s style inflation. We haven't had that in the last 20 or 30, well, obviously in the last 40 years doing arithmetic. And so market responses to the Fed, equity market responses to the Fed we're not going to see the same kind of sensitivity of the Fed to market moves as we've had when inflation was not a problem.
So, John, it actually is probably appropriate that you guys started the conversation talking about football and that people would rather talk about football right now than this, because it's basically been the same story for a number of weeks now. And basically, the Fed is going to do its thing. It's on autopilot. Let's reconvene in September and see what happens. It's a quiet day for data. Going forward, what's going to change this narrative? Is there a data point or a series of them that you're looking for to really guide into September?
It's the persistence of inflation, Lisa. The Fed, all my interactions, all my reading, the Fed is serious about getting inflation back towards the 2% target. And the problem is they don't know what it's going to take to get there. There's something of an odd narrative coming from Fed officials where they talk about 2.5% being neutral, because that's the long-run neutral rate when inflation is back at the 2% target rate. And right now, inflation is much, much higher than that. And underlying inflation is probably somewhere around 4%. So the Fed's talking about, well, we need to get back to neutral, and then maybe we'll have to get a little bit restrictive, and throwing that 2.5% number out there as the estimate of neutral once inflation's defeated. And that's a little bit putting the cart before the horse when you're trying to defeat inflation. But they are insistent. I think they're going to move towards that 2% target. And so the opportunity to dial back is going to depend how much inflation has fallen over the summer. And I think that the chances are that inflation doesn't ebb as much as the Fed is hoping at this point, because two things. There's the broad-based nature of the price increases. And we calculate in the last CPI report, for example, there was 63% of the items within CPI that were rising at a 6% or faster rate over the last year. So that's very broad-based persistence. That's the first thing. And secondly, there's inflation expectations by the public. And they are holding in longer-term expectations by their fingernails. And yesterday, we had the Philadelphia Fed reporting that 10-year inflation expectations by businesses had gone up from 3 to 3.5%. People are seeing food price increases, and very sadly, and this conflict in the Ukraine has such terrible humanitarian dimensions, but the main economic dimension for the U.S. may well be higher food prices because of the impact on grain exports, because of the impact on fertilizers. And that feeds into people's expectations, because that is repeat shopping every week where they see prices rise.
That was a clinic. I want to go back to David Malpass, John Writing, and Conrad de Quadros of ages and ages ago, John. And the bottom line is, maybe for whatever reasons, your worry back then has happened. We are so far from any constructed Taylor rule right now, it's unthinkable. And as you correctly say, we're hanging on to inflation expectations by our fingernails. What do institutional leaders do to quell the fear of higher inflation expectations? What's the prescription to keep us hanging on by our fingernails?
Well, I think what we really need is a new monetary policy framework strategy. I think one area
targeting? Are you going to go all New Zealand on me here?
Well, look, the Fed has a 2% inflation target and had a 2% inflation target, but they bemoaned missing it to the low end by a few tenths of a percentage point. So they adopted a deliberate strategy to raise inflation and raise it above 2% by a moderate amount for some time. And now, careful what you wish for, we've got it substantially above 2% for a prolonged period of time. And now, what is the strategy? They need to really reassure the public in various ways, not just in Fed statements, that they are very serious in getting inflation down, because it turns out inflation is not the stimulus to economic activity that the Fed hoped, at least moderate inflation. It's hard to hold it at 2%, and the public hates inflation. Jonathan and I, for example, have talked about this a lot, about what our mothers think about it, and neither of our mothers think that inflation is very good for them when they see what's happening to the utility bills.
John Farrow, talk about that right now. You and Writing are living this in real time.
Oh, the family chat yesterday was lighting up, Tom, just in terms of petrol prices going up and away. And John, just to speak to what the mums are going through right now for you and I. For personally, the call I get all the time is about a utility bill at the end of the month. And for those listening in, don't worry, I pay it. And I'm sure John does too. John, things are getting really, really tough for people. What we saw this week from the retailers was just a shift in where they're spending. I'm not sure if we saw a drop-off in how much they're spending, though, John, because when I hear from the airlines are talking up how robust things are, how resilient the consumer is, that the price tolerance is still there. What's your read on that, John?
Well, I think that's right. I think that companies are having difficulty managing an inflationary environment and an environment in which there are severe labor shortages. We need more workers, and this is a weekend, fortunately, across New York City where we're going to see those future workers appear, as you see all the graduates on the street, and that's great and that's hopeful for the future. But right now we're in an environment of labor market constraints. And those constraints are causing companies difficulty in managing their businesses. And so I think the story of those retailers earlier in the week was really more of a margin story than it was a consumer spending story. After all, April retail sales looked fairly sprightly numbers.
Yeah.
April industrial production looked quite strong. Even April housing starts were flat on the first quarter, and that's the most interest-sensitive sector of the economy. So I think all these fears that this is really about demand shortages are misplaced. There's tremendous excess demand, almost 2 job openings per worker. As I said, that's good news for those graduating this weekend. If we take some demand out of the economy, we're really taking excess demand out. My fears of recession in the short run are very low. The problem is the longer term if these inflation expectations become embedded.
John, 15 seconds on the clock. Finish where we started. Results Sunday. Prediction.
Liverpool win and Aston Villa hold City to a draw, and the quadruple still on.
There we go. John Riding of Green Capital. John, thank you. Futures positive 1% from New York City. This is Bloomberg.
Keeping you up to date with news from around the world. With the first word, I'm Ritika Gupta. President Biden is in South Korea, where his immediate focus was on the semiconductor shortage that has dragged on the global economy. The president toured a Samsung factory and has some of the biggest chip production lines in the world. Samsung is breaking ground this year on a semiconductor factory over in Texas. Meanwhile, Bloomberg's learned that President Biden is considering a meeting with Saudi Arabia's Mohammed bin Salman as soon as next month. That will mark a shift for the president. He's avoided contact with the Crown Prince over the murder of journalist Jamal Khashoggi. U.S. growth may outpace China's this year. That's for the first time since 1976. According to Bloomberg Economics, China's economy will grow just 2% this year, due in part to coronavirus lockdowns. Meanwhile, the U.S. economy is likely to grow 2.8%. China's goal of around 5.5% this year was the lowest ever set. And the largest maker of agricultural machinery, Deere, reported quarterly sales that were below estimates. The company says that higher costs had an impact on farmers. Disruptions related to the invasion of Ukraine helped elevate prices of fuel and feedstock that could lead farmers to put off investments in machinery. And shares of Ross Store are plummeting in pre-market trade. The discount retailer cut its full-year outlook, and first quarter results missed estimates. The outlook downgrade follows similar moves by Kohl's, Target, and Walmart. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
worries about what they call black soot, caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes, have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now, we are dying slowly but surely, and our lifespan is reducing every day.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Soaring energy prices and a short supply of key chemicals that produce synthetic fertilizers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertilizer helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost. So it breaks down, the manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question. Great question. Great question.
Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
This delicate balancing act is what the Fed's got to navigate, what all central bankers have to navigate. And everybody's afraid that they're going to get it wrong. And the chances are that they will get it wrong.
A spirited Lori Heino, Global Chief Executive Officer, Chief Investment Officer. I didn't want to give her a promotion there on a Friday. We were on her weekend. With State Street Global Advisors. We're thrilled that she could join us here this morning. Lisa Bramowitz and Tom Keene, and we thank you for being with us. Futures up 36. Kriti Gupta with a chart to stagger to the weekend.
Well, we have to talk about President Biden going to Asia. One of the key reasons he's doing that is to really secure up and look into the issues that are in the supply chains. At the core of it, or at the crux of it, is those semiconductors. And that brings me to my chart of the day. We're looking at the Philadelphia Semiconductor Index, otherwise known as the SOX Index. We're keeping it simple here, Tom. A 2-year chart that shows the powerful rally that you've seen in chip stocks. It goes higher, higher, higher. And a lot of that driven by this chip shortage, this nonstop demand, the ability to pass on more cost to consumers. But then if you look year to date, you do start to see a pullback. Now, some of this is going to be that macro risk-off sentiment. The other part of it is simply how many of these companies aren't able to keep up in terms of capacity when it comes to chips and are also facing perhaps the fears of some of that demand destruction.
Chips at the heart of all of it as well. Kriti Gupta, thank you so much. This is a joy. Ben Emmons is a managing director of global macro strategy at Medley Global Advisors, but he's actually the person I hate the most within the racket. The reason is he writes nicely long memos that are forced to be read. Lisa and I hate him with a passion, and we're thrilled he could join us this morning. The China note was mesmerizing, and at the bottom end of your note, it is shocking the rebound that you call for. When and how big will be the rebound of China?
Yeah, we think it's happening as we speak. So the Shanghai lockdown is easing.
in some parts. But, it's an infrastructure-led rebound. Now, it may not lead what we saw in the US of this really sharp, like V-shape, but in China terms, it's obviously significant. The way they shut down is nothing what we did. It's like an industrial shutdown by keeping, by the way, factories open for foreign companies. But at the end of the day, I think it's a rebound that's meaningful, at least like say a relief to global markets. There's also another story than all the dismal situations that we've seen this week. A global reopening. That's that China story.
When I look at my shock of the week, besides of course the inflation numbers out of Europe, was Newcastle, Australia coal, which is basically unmeasurable. It's such a moonshot. Is that one indicator of what's to come for an August China or a November China?
Yeah, that's for sure. I think that China pent up quote-unquote demand for commodities is a theme that may come back. It's not something that has really abated from, let's say the negative sentiment is overhanging the equity markets of, there's a recession coming in the United States that should lower demand for commodities. So
I think Lisa, at mid-year here, this is a massive, massive part of a jigsaw puzzle that no one has an answer to. And, Ben is clearly polarized here with a huge rebound there. But the China mystery, to me, is the biggest of all mysteries.
And how much does this bleed into possibly more persistent inflation versus some resolution to supply chains, Ben? How do you parse out a recovering China into the current moment where we're seeing somewhat of a slowdown on the peripheries, but also that inflationary push based on supply chain disruptions?
Yeah, if you take, Lisa, the supply chain index from the New York Fed, they just put that out a few days ago, and it showed there the contribution of China of, again, increasing the pressure on the supply chain globally. And that, I think, is lingering still here, even though the reopening of China is upon us, and in the quarter or so that will happen, that supply chain pressure is not easing. So you do have to factor this in inflation. And to earlier discussion with other guests, people try to figure out how tight financial conditions have to be for our inflation rate to really start roll down. I thought it was interesting that if you input the commodity analysis that we've done with Energy Aspects with my colleague Emery de Sen, you actually offset a lot as a result of tiny financial conditions, but an energy shock that's still very strong there, including the supply chain pressures, that inflation is going to only very gradually moderate in the coming year, perhaps less even than what the Fed predicts.
So, Ben, do you think that this actually calls for the Fed to actually get more aggressive than people think by the back end of the year, simply because you don't have any slowdown and that you actually get a reigniting of some of the momentum that's allowing inflation to be more persistent?
I think that is the tone from the Federal Reserve that we're hearing. I thought that Powell, again, was quite resolute in the Wall Street Journal interview of being really committed to sustain this tightening path, unlike Evans, who came in and said, well, we could maybe moderate tightening over time. Most of the FOMC seem to be more coming around what Powell thinks we have to continue until we get meaningful decline in inflation, as he says, like consistent, meaningful decline. And that's not where the state we're in. So, yes, the Fed could get to a second inning if by the end of the year, tightening further.
Lisa, that's baseball talk, second inning there.
Thank you, I appreciate it.
Football talk.
That's great.
Ben Emmons getting us back to America with the baseball talk. Thank you so much with Medley Global Advisors. Lisa, we got to sum up here as we leave on a jet plane. Francine took the Gulfstream back after the Ken Griffin interview. You and I are going to stagger over there. And I'm absolutely fascinated by how this Davos confronts the new history that we're all confronting.
Yeah, and how does it, frankly, regain some sort of to everyone, right? I mean, how do you deal with inflation at a time where you have some people worrying about just, whether they want to go on that extra trip and other people worrying about whether they're going to have food to eat, Tom? I mean, honestly, how do you parse out this differential?
Yeah, and as Robert Gates has said, and we heard this from General Kimmett as well, the holiday from history is over. Lisa, safe travels is well over there. And we've got a guest list. We're going to keep the guest list quiet, folks, because there's a lot of give and take and schedules and meetings and meet and that and all. We're trying to get Steve Garrard to come down after Aston Villa gets it done. I don't know if we're going to be able to pull that off.
One of the big questions, I think, heading into this Davos is the new globalization or the new polarization in in different powers. I know you're like saying, wow, she just totally blew over that perhaps. Yeah, but, I mean, what did you expect? Did you think that I would engage?
No,
with the,
no, I did not. And all next week, I don't think you're going to engage as well.
I'm just kidding. Honestly, I think that there are some very big questions, aside from Premier League football, which I will give you ample time to talk about with all of our wonderful guests. There is an issue of how we deal with supply chains in a new reality at a time when there are new poles of power. And this, I think, is really underpinning a lot of people's view in more sticky, persistent inflation.
Well, this goes back to Angela Stent in my book of the year, folks, Putin's World, and she does not predict this, but she brings up the idea, Lisa, here of a return to Yalta, of an America, of a Russia, of China, and really a rejiggering of things, which goes to Bloomberg and the president perhaps visiting with the royalty of Saudi Arabia.
And honestly, we're coming off those retail sales that throws this into hard numbers, right? At this point, it's a margin story for a lot of companies that are dealing with the higher inflation, the supply chain disruptions. At what point does it continue to go to an inflation story versus a stagflationary type of environment?
Yeah, the inflation story to me is a huge deal. We underplayed Europe inflation this week, which is really shocking as well. We are steeled for a weekend of travel, and we will join you Monday, is it, Lisa?
Right now, it's
Monday.
Oh, I thought you were asking if it's Friday right now.
Good morning.
Yes, Monday we'll be there.
the Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. Chairman Ajay Singh earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. There's a big celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet Chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, we're heading for a 7th straight week of losses and looking to take a bite out of those losses at the open. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York City, we begin with the big issue, another exhausting week in markets.
The number one issue here is a re-rating of the market.
This has been a valuation re-rating.
Long duration assets are taking on the chin right now.
Every single headline is negative.
The way that the market is reacting is as if there's a recession coming.
The consumer narrative is starting to fall apart.
Potential weakness from consumers are already starting to come through.
We hit this oversold level on the S&P 500.
We have proper kind of recessionary pricing coming through. The pessimism out there is really remarkable. It's really widespread.
The market is, it's trying to find a bottom in here.
I don't really know where the exact number for that is.
Over the summer, the S&P could touch down to around about 3,600. We're seeing a lot of headwinds. There's a lot of pieces moving around here.
It's hard for investors to get past the day-to-day.
Joining us now, two of those investors, JP Morgan's Clinton Warren and Victoria Green of G Squared. Victoria, first to you. How will you know when we've seen the worst of it?
Well, we haven't seen a panic yet, so we haven't seen this capitulation. I mean, I know that Tuesday was ugly, but we really haven't seen the market truly roll over. We have seen some supports hold, that 3,800 level on the S&P 500, but we're not there yet. So we're certainly watching charts, watching signals, looking for a bottom. I just don't think we've seen the capitulation in the broad market sell-off. You're seeing more, right? Some of your safe havens, your Targets, your Walmarts of the world have rolled over, and you're seeing the struggle in retail with inflation, but you just don't have a panic yet. The VIX isn't above 40. You look at some of the number of stocks that are hitting new 52-week lows. Some of these other signals, you would really see a true capitulation. They're just not here yet. So I don't think we're going to leg down another 20%, but, is today going to be the bottom? Remember, last Friday, we got a little bit of hope too, and then that got squashed immediately this week.
Clinton, your take.
Yeah, I mean, it's just so hard to dictate where that bottom is. It seems like the market is just holding on to every piece of information and every headline that comes out. Just this morning, we're getting some positive news from China, right, that they are going to be stimulating their economy to the tune of like $2 trillion. The 5-year prime rate came down 15 basis points. And this news, just this news abroad is giving us some nice green finally this week in the U.S. future. So I don't think we're at the bottom yet. There's probably a little bit more to go. It's going to be completely data dependent, and the market's holding on to each piece of data that comes out every single day.
This is what I want to talk about. Is it a break in the price you look for or a break in the policy? Which one? Bank of America say this: true capitulation happens when the Fed capitulates. Michael Hartnett and the team go on to say a systemic event and an unemployment rate rise is required first. The bottom line is that we're vulnerable to a bear market rally, but we would still argue sell any rips. Victoria, does that resonate with you?
Yes, we are 100% don't fight the Fed, and the Fed is going up. And I think everybody hoping for a Fed put is going to be sorely disappointed. The Fed's not going to be Santa Claus this year. They're not bringing a present. The Fed has to hike. They have to get inflation under control. They're late and they know it. I think they've got a minuscule chance of avoiding a hard landing. They've really never navigated this market well. And so at this point, they're just trying to put as much distance between them and zero, get some wiggle room to when the economy starts rolling over. They need unemployment to start rolling over. They need to stop this runaway train, and I just don't see them stepping in just because the stock market's in a bear market. I get the concerns on liquidity, it was mentioned, but look, the Fed has to prioritize. Their mandate is inflation and unemployment, right? And unemployment, they can safely check that box, definitely at full employment. But inflation is runaway, and they have to fix this problem, and they're not going to bail out the market this time. I don't think you're going to see that, and I think anybody waiting for the Fed to help is sorely mistaken.
Victoria, do you get the feeling that investors still don't fully understand that? Just in your private conversations, your more broader conversations with clients, with people in the market, do they understand that this is a feature? It's not a bug of monetary policy. This is the goal, the objective.
It's hard because the Fed has stepped in before in 2020, even in 2018. And I will put out there, I'm aware it's an election year. I know they're supposed to be non-political, but you kind of look at what happened in 2018 and some of the others. They're not agnostic to what's happening in the political universe this year as well. But they have to. Their mandate isn't saving the market. And that's hard because they have done that recently in 2020. And I feel like that was a one-off and that's not going to be repeated. So yeah, a little bit here. It's hard to have this tightening Fed. A lot of people have forgotten what a truly tightening Fed market is like because we really haven't had that in over a decade. You know, we've had these little blips of a tightening cycle, but they've always been very short. And I don't think actually they're going to get that far. If they get to 3.5, you know, I'll buy you a beer because at some point this is going to roll over and the markets are moving at warp speed. So I think it's going to roll over a little bit faster than everybody's anticipating, which is why we've been talking about a recession since the beginning of this year.
Priya Misra of TD in the same camp. She does not think the Fed can get that far. Clinton, I hear a lot of people come on this show. It's been a feature of this program this week. They're bullish long-term into year-end, if you can call that long-term, but over the next 3 months, they want nothing to do with it. They believe, though, the relief rally kicks in because inflation fades and the Fed backs away. The Fed backing away. Clinton, I hear it so many times in every conversation, the Fed's going to back away. That's not a call. The real call is, do you fully understand the conditions, the circumstances under which this Fed does back away, and when do you think we achieve them? When do we meet that threshold? Clinton, what's your view on that?
I think everyone, I just remember last year, everyone was talking about inflation being transitory. I think those same people are holding on to the hopes that we have hit peaked inflation and inflation is going to start coming down, which will give the Fed some ability to pause. But I just don't see that happening. If you look at the numbers, if you look at what's going on, inflation is going to be here. So the Fed is going to hike 50 basis points in June. They're going to hike another 50 basis points at the end of July. They're going to be watching the data. They're going to go through neutral. I think you're not going to get your beer to. I don't know if they're going to go all the way to 3.5, but I do think they're going to get to 2.75 or 3%. Because they have to get off from where we are, and we just have to remember that we were in a long expansionary period before the pandemic.
Yeah,
we're in this huge booming recovery. There's a recession is coming at some point, and the Fed needs some room to give the market some stimulus when that does happen.
If they go above 3.5%, I think there'll be a lot of people in this market who will need more than just a beer. About 24 minutes out from the opening bout, futures positive by about 1 full percentage point. Katie Lyons, we're going for week 7.
We're going for week 7. I think we all could use a beer right now, John. More than $1 trillion wiped off of the S&P 500 in terms of market value this week alone, down 3% on the week. So yes, while futures are positive today, it doesn't look like we're going to be able to claw back all of those losses. So yes, we could be heading now for the longest weekly losing streak on the S&P 500 going back to 2001, more than 20 years. Now, if there's any good news, it does look like if the gains we're seeing in the future session hold, we will avoid a bear market just barely because the index is off about 19% from its record in January. But of course, the drama hasn't just been limited to equities. We've seen these growth concerns rippling across asset classes, including credit, where you are starting to see some bleeding. High yield spreads now widening out to 479 basis points, and collectively between high yield and investment grade, we've seen about $7 billion in outflows in the week through May 18th. Where money was pouring in, though, the perceived haven of full faith and credit, government treasuries, seeing about $5.7 billion in treasury inflows this week. Finally, just to check on commodities as well, because there's been a fair bit of volatility there too. It does look like oil will end the week higher by a little more than 1%, at least at the moment. That would be the 4th up week in a row, the longest winning streak on WTI going back to February. You also have aluminum higher, but gold, worth noting, John, forget about the Fed, 1.7% gain on gold. That would be the first weekly gain in 5 weeks. It goes back to the idea of seeking haven in the middle of a growth scare, John.
Kelly, thank you. Let's talk about defense. One feature of defense for some people in this market, consumer staples. Staples this week are down almost 9%. Close here, worst week since March 2020. You know what happened then, I'm sure you don't forget. Why would you ever forget? Down 9% on consumer staples this week. Victoria Green, talk to me about your response to just how quickly, how fast staples corrected this week.
Yeah, and a lot of that, I think, was retail, right? Walmart really struggled. And when we see the inventory pain, and also I think what was most interesting in retail was that they're talking about the consumers shifting their behavioral patterns. And that is something that should be a red flag to everyone. They're changing, they're buying down to store brands, they're not going after electronics. Inventories are rising. You know, you've seen that continued. Walmart, Target, Ross stores, you know, they really struggled again, and they had pretty dour outlook on the year. And so Staples was one of the safe havens. They were trading at a bit of a higher multiple multiple still, and they still are a little bit high. I think average is still 20 times earnings, but even the safe havens of staples right now, you're seeing them get hit just because of the inflation story and then the consumer slowing down. We cannot deal with $4.50 gas and then expect the consumer to not have to change their spending habits. It's unreal. So I think this is this reality check that you really need to be looking for in industries and areas of this market that are a little bit more inflation proof, because I think inflation is going to kill everybody's margins, and that's why we still like the energy sector. We're a little bit in healthcare. You know, poor baby financials can't get off the ground, but they should do a little bit better here. We're looking for areas that are less exposed to inflation, because inflation is eating margins.
I'll come back to the energy story a little bit later as we get towards the opening bell, but just to stay on staples, everything you said, Victoria, is obvious. I hear you. Makes perfect sense. You and I have been talking about it now for months over the last year. Yet the fact that Walmart was down more than 10% on any given day, one day, the fact that Target was down almost 25% in one session. Victoria, did that spook you? Because these are things that sound obvious, yet they are seemingly really poorly priced based on the price action.
Well, I think sometimes investors need to show me, right? Maybe there's something better under the hood. That's why we get excited about earnings. Sometimes you get a good surprise. I think Amazon was the canary in the coal mine when they struggled, Walmart and then Target, and you're just seeing this domino effect that nobody was immune. I mean, for God's sake, if Walmart isn't making as much money, that's a horrible outlook for the economy, because they're the beating heart of the American heartland. Walmart is where a lot of people shop. And when you have these changes, I think it's just eye-opening. Rip the Band-Aid off. It's getting kind of bad out there. And I think investors need to realize the consumer is what drives the American economy, and the consumer has been asked to absorb so much this year. Inflation, gas prices, rent prices, they're dealing with struggling with their wages not rising fast enough. And you're finally seeing that play out in earnings, and the margins aren't going to be protected anymore. And that's what's giving right now. They can't hike prices anymore. The consumers are already changing their behavior. The U.S. economy lives and dies with the U.S. consumer, and the U.S. consumer is raising a red flag that they cannot absorb more inflation, and they just can't continue to spend. And when their spending slows down, that's bad for everybody.
Clinton, final word here.
I totally agree. I mean, it's pretty simple to me, right? Costs are going up. Americans do not have as much money to spend on discretionary items, so they're not going to. Prices at the gas tank, prices for food, they're all just hurting everyone's wallets and pockets. And the inventory buildup, so those are going to be here for a while. Companies aren't going to be purchasing from suppliers. So I think the margin story is what we really need to watch. If companies are not able to pass on these increased costs to the consumers, which I don't think they're going to be, margins are going to be squeezed, which will definitely hurt EPS, which will definitely help the stock market not continue on this upward trajectory that we're seeing today. So it's going to be a tough ride up there. But look at the margin. That's where the story is.
If the airlines reported this week and not the retailers, though, would we say something different about the consumer?
Well, I mean, maybe. I mean, if you look at travel, TSA numbers are up, not only for personal use, but for corporate use as well. So possibly, one of the things that I've been watching is in-person dining at restaurants and bars, which is up 20%. So people are moving from goods to services. We've been talking about that for a while. But I think the retailer story is what's driven headlines this week, and what people will be rightly focused on in the weeks to come.
Clinton, you're going to stick with us alongside Victoria. Thanks for being with us. We're about 18 minutes away from the opening bell. Futures positive 0.9%. With your movers, here's Abby.
Earnings continue to roll in, John, and a number of them are retailers that we'll be taking a look at. But first, Deere shares are down sharply. This after the company missed revenues for its ag division by about 13%. Not surprisingly, costs rising due to the supply chain. But there are two sides to the coin. They actually raised their revenue view on the belief that crop prices are going to rise more. Ross Stores, the discount retailer, plunging down 24% as their low to mid-income customer base squeezed by rising costs, really not there to support sales. Inventories absolutely ballooned, up 57% year over year, more than Target, Kohl's, and others. However, this is really interesting. Speaking about discretionary, nice to have, Foot Locker and Deckers both doing quite well. Foot Locker up 3%. They beat and offered a strong forecast showing that they're managing Nike's decision to sell more through their own channels. And then take a look at Deckers. Folks want their Uggs, up 14.6%, a massive top and bottom line beat. So a few nice to have discretionary names actually doing okay, John.
People still wear Uggs.
They still wear Uggs.
I didn't know that. What would I know anyway? But I didn't know that. Abby, thank you. Coming up, President Biden on tour in Asia.
The alliance between the Republic of Korea and the United States of America is a linchpin of peace, stability, and prosperity for a region of the world that we seek.
That conversation up next.
Companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
The COVID-19 pandemic exposed the fragility of just-in-time supply chains. The global semiconductor shortage has caused a shortfall in consumer goods, especially automobiles, and it's contributing to higher prices around the world. And now, Putin's brutal and unprovoked war in Ukraine has further spotlighted the need to secure our critical supply chains so that our economy, our economic, and our national security are not dependent on countries that don't share our values.
The president promoting a US-South Korea partnership, hoping to reduce the country's reliance on China when it comes to the supply chain. The tour will run through Tuesday. He'll head to Japan later this weekend. I want to head to AMH now, over in D.C. Anne-Marie, the goals of this tour, what are they?
Well, Jonathan, one of them we've just heard there is the president wraps up his first day on this tour, and that's about semiconductors and really trying to shore up these supplies. The administration has been begging Congress to pass that broad-based China competitive bill. It has tons of money for manufacturing, including $52 billion for semiconductors. And you heard it there. The president even was able to pivot that to talk about the biggest domestic concern his administration is facing, and of course, that is inflation. The other, and they may not want to point the exact name, but it'll be about competition with China. And a lot of this will come into focus when he moves over to Japan. He'll be meeting with his Quad leaders. That includes Australia, Japan, India. And on top of that, Jonathan, the administration is talking about this new Indo-Pacific Economic Framework, IPEF. This is basically TPP light. And there's a lot of reporting that the administration itself has had to dilute the writing of this and how they're going to introduce this, according to the Financial Times. So it's not about getting that same access to the U.S. market, but it's a little bit of an introduction, a placeholder this administration is looking to in terms of the economic competition against China.
TPP has a branding problem. We know that. We've talked about it for a while.
I think so does the EPEC.
Just a bit. Yeah, that has a branding problem too in a different way. Just quickly, a meeting potentially with the Crown Prince of Saudi Arabia, Mohammed bin Salman, and the President of the United States. Your thoughts on our reporting in the last 24 hours?
Well, it comes as oil prices hit another, or gasoline prices, excuse me, hit another record today, $4.59. Obviously, this is something that the administration is laser focused on. And when you look at who has the spare capacity in the world, it is the kingdom. My reporting a few months ago, along with colleagues in Washington and in Riyadh, was that there has been a little bit of a change in thinking within the administration. You had some officials really wanting the president to pick up the phone and deal directly with Mohammed bin Salman. But the issue is he came into this administration calling him the Saudi Arabia pariah and saying he's only going to deal with his counterpart. Obviously, the war in Ukraine has really shifted things and the inflation story. So potentially we could see this meeting. It's going to be battling a lot of different factions within the Democratic Party. They're dealing with inflation, but at the same time, a lot of people in this party do not want to see the president shake hands with Mohammed bin Salman after, of course, the killing of Washington Post columnist Jamal Khashoggi. So this is going to be a tricky one.
A very tricky one. Anne-Marie, thank you. Just to stay on energy, we caught up with Savita Subramaniam of Bank of America. Take a listen to this.
I think what you want to buy at this point in the cycle is still very late cycle inflation beneficiaries. So we're still overweight energy. I think energy, to your point about China reopening, oil could be depressed right now, just given the fact that the second largest economy in the world is offline.
Victoria, back over to you on energy. Do you agree?
No, I think energy is a great place to be. I don't think we're going to see oil prices come down. You took such a major player off the market with Russia, and you're seeing right now kind of this global rebalancing of where everybody gets crude. Unfortunately for the gasoline picture here, it's the refiners. We're already running at 95% capacity. Refiners are actually running about as fast as they can to refine petroleum into diesel, into gasoline, and to get it to the consumers. We just don't have really the capacity. So let's say we get some more crude, which would probably stop us from exporting as much crude. You still have this problem of we have to refine it. We have to get it to you at the pump. And that problem and that infrastructure really can't support that much more. So I don't see a lot of relief at the pump because I don't see refinery capacity picking up that much. I do see, I like the energy market. I think it's a great innovation play. I love the US E&P market, your Devons, your EOGs, your Diamondbacks, because they have such low break evens. And I do think we're going to actually see US producers pick up market share as Russia steps out of the gas market. You could see US nat gas getting exported more. Again, you're somewhat constrained by infrastructure. Even the very, very large crude tankers and things like that, it's not like we can build those in a month. So some of this stuff is just a difficult rebalancing and shifting. I don't see oil prices coming down that much. Even if they hit 90, you're seeing a lot of, especially the Permian Basin producers, their break evens are in the 30s and 40s. So if you're looking at a way to offset inflation, I think energy is one of the best spots to be in this market. I know it's a little scary after this run up, right? Devon was S&P 500's best performer last year. Yeah. We're still seeing strong performance this year, but I think this area is going to do well in this market, and I don't see a catalyst for what's going to change. I don't think we're going to get Russian crude coming back. I mean, maybe China and India, I know they're kind of doing some backdoor deals, but Europe and the rest of the developed world, the U.S. can now pick up supply, providing supply, and I think that's going to be a place you can actually make money this year.
Clinton, you've got 30 seconds on energy. Your view?
Yeah, energy's been one of the few sectors that have run up, and I think there's still room to run. And for me, it's just simple economics, right? Supply is low for a number of reasons that Victoria just mentioned, and demand is going to increase. So supply low, demand increase, simple economics. My Economics 101 course says that means prices are going to at least stay stable, if not go up. So energy is a nice place to look at over the next 12 months.
Clinton Warren, Victoria Green. At some point, part of the problem, energy, becomes a victim of the solution. Higher rates, slower growth. We'll get to that another time. Coming up in the morning calls and later, wrapping up a painful week for the US retailers. Nuveen's Brian Nigg joining us on the consumer in America.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
About 4 minutes away from the opening bell in New York. Good morning to you. Futures are positive by 1% on the S&P. That's the price action. Here are your morning calls. Baird first up, upgrading Comerica to outperform. $85 price target, seeing a number of compelling opportunities following the stock's recent sell-off. Telsey downgrading Ross Stores to market weight after disappointing results. Another one expecting shares to remain under pressure amid continuing supply disruptions. We're down 24% there. And finally, Citi removing Amazon from the company's focus list, citing macro headwinds and concerns about the US consumer. Coming up, Nuveen's Brian Nick says the consumer is strong and still spending. That conversation up next, your opening bell, just around the corner.
Energy prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down. The manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
25 seconds away from the up and about this Friday morning. Good morning to you all. The price action looks a little something like this. We're positive, about to take a bite out of a weekly loss, but still set for a 7th straight week of losses, the longest weekly losing streak since 2001. Futures positive on the S&P, on the Nasdaq too, by 1.2%. That's the opening bout. Switch up the board and get to the bond market for a 2nd straight week. Yields are lower on the week, on the session higher by 2 basis points on a 10-year, 285.68. Euro dollar 105.62, negative 0.25% on that currency pair, and a few weeks out from a really tricky ECB meeting for President Lagarde. June 9th, make sure that one is in the diary. Commodities basically unchanged on crude, 112.23, unchanged and higher by what? About 2 cents on a barrel right now. About 25 seconds in, let's get you your movers. Here's Abby.
John, tech dip buyers are certainly out there in force this morning with that Nasdaq 100 outperforming, and perhaps it has to do with this week's losses, the year-to-date losses being just too tempting to give up. Apple down 6.6% into today, down 23% on the year. NVIDIA, the chip maker, down 42% on the year. So today these stocks are up. Probably has something to do with yields coming in, not on the day, but on the week down, last week down, giving up nearly 30 bips over the last 2 weeks. That 10-year yield coming back in below that eye-popping 3%. Even so, Apple is still at high valuation. So with those declines on the year, making yields coming in look a little bit more attractive. Apple trading at a 21 times forward PE. John, shockingly, over the last 5 years, that's closer to peak valuation as opposed to trough. But this morning, folks like Apple and the other big tech names.
I'll tell you something I don't like this morning and on the week, and Abby, thank you. Retail. Ross Stores down by almost 23%. Another one. Cutting its profit forecast with surging prices eating into margins. The CEO saying the following: given our results and increasingly uncertain macro and geopolitical environment, we believe it's prudent to adopt a more conservative outlook for the balance of the year. Katie Lyons has more. Hey, Katie.
Hey, John. Another one bites the dust, and it feels like the late 1980s all over again. It was the worst day since 1987 for Walmart and Target after their results. This could be the worst day for Ross Stores since 1986. Absolutely brutal punishment for being another retailer to cut their profit outlook. A number of sell-side analysts cutting their price targets on the stock today. One over at Wells Fargo saying this was one of the most surprising and disappointing prints we have seen from them in 10 plus years. And of course, Ross is far from alone. It's just joining the ranks of the other retailers we've heard from who have seen similarly massive declines this week. All of them struggling with higher costs on the supply side that they're now having difficulty passing on, specifically to the lower end consumer that is facing higher bills at the gas pump, at the grocery store, and maybe starting to change some of their discretionary spending behavior. It's about the product mix and demand for certain things more so than demand in general. And as a result, retail has absolutely taken it on the chin, down more than 24% in the month of May, following a loss of 11% in April, together the worst months since the financial crisis of 2008. And of course, what's interesting, John, is in the year through Monday, Staples provided some defense, one of only two sectors in the S&P 500 in positive territory on the year. Second, of course, to energy. That changed in a big way this week with the consumer staples index down about 8.4%, discretionary by about 5.4%, and of course have taken the broader market down with them, John.
Another one. Wasn't that DJ Khaled?
Yes.
I'm like the least cool guy here.
but it's not another, it's another.
It's
like
okay.
at the
That's how you say it. Do we need a button so he says it for us? Would we have to pay? Whatever. Kelly, thank you. Equities are down. Through the week, they are up on the session on the S&P by 1%. It is retailer after retailer saying the same thing. Here's Foot Locker. Supply chain costs will keep dragging on margins. Taylor Riggs, how many times have we heard this week?
Maybe a dozen or more, John. And I think you're right that sort of earnings season, I think traditionally was such a time when we could think about the fundamentals of a company, the health of the balance sheet, get back to basics. And I think this quarterly earnings results has been an entirely different experience, one that we haven't had in a few quarters, where it's actually been a time of a lot of uncertainty and negativity. Here, of course, is an example of that. Just yesterday alone, analysts cut price targets 162 times on a lot of other different companies. Upward revisions were only 62. So that really highlights the negative sentiment that really here is underway. We talked a lot about how these companies really did well during the COVID boom. Well, all of that, sort of the bottom line of these companies has been wiped out when we think about how the focus has shifted from top line in a nominal and an inflationary environment to frustrations about margins, cutting forward guidance, particularly on the bottom line as well. So that is sort of the EPS here that has been wiped out. Another very interesting trend, John, is typically when you do okay and the quarterly results are okay, the market reacts okay. Here, if you miss and you miss just a little bit, the market reaction has been brutal. This is the one-day reaction to the quarterly results. Netflix, you dropped 35% after your results. Target, you dropped 25% after your results. Dish, right? Etsy, Cisco, as we learned yesterday, Walmart, as we learned this week. The negative price reaction the next day has just been unbelievable.
Taylor, just a point from me, and I wonder what the coverage has been like in the afternoon when you have this conversation with guests. I've been surprised by how surprised people are by this, how surprised the C-suite was by this, how surprised the stock market seems to be by something we've been talking about repeatedly for months. Guest after guest talking about the same thing. Margins are going to face pressure. Here we are, it happens, and you have moves like 25% on Target.
I asked two sell-side analysts this yesterday, and I said, with all due respect, you guys are forecasting and doing an incredible job, but how did you get this so wrong? How do you think that estimates are for a gain of 3% and top-line same-store sales is now looking at a guidance of off 5%? And they said it's one of the trickiest environments in which they've had to forecast, and I think the companies had a really strong start. If you think the first couple months, a lot of this started to deteriorate in March, and by the time that you try to get to making the bottom line match with what the street was looking for, the numbers were too hard to make it up.
Taylor, awesome coverage as always. Taylor Riggs, thank you. Looking forward to the coverage a little bit later at the close. This has been the story. These C-suites, corporate executives, struggling to find the right balance. They're set up for 2021 now, in 2022. And all of a sudden, so many of these names, Lisa Abramovich has been talking about this repeatedly. She's done a great job on it. Walmart, Target, Amazon, they're going from being understaffed to overstaffed, from undersupplied to being oversupplied, and then the product mix, the mix of the consumer, where the demand is shifting as well at the same time. This is a really difficult one to forecast and a difficult one to read. Brian Nikonuvin joins us right now. Brian, you've got a different read on the consumer. Just give me your takeaway from what we've heard from these retailers this week.
Well, I was nodding along to what you were saying about this being something that we were talking about for months. We've been hoping for, expecting the rotation in consumer spending out of goods into services for months now. And frankly, we were early on that call, and that's been part of what's exacerbated the inflation story and caused the Fed to have to think about raising interest rates so much more than we expected it to just maybe 9 months ago. Overall consumer spending is still really strong. We got retail sales data this week that showed a better than expected mix of consumer spending. The strongest components of that were restaurant sales and online stores, so not necessarily hitting one for one with the stocks that took the hit this week. But next week, we'll get overall consumer spending that will include services, and I expect for April, that's going to look even stronger as this rotation continues. The reverberations of the pandemic are still, I think, to an unappreciated degree, warping what we're seeing in the consumer spending mix at this point.
So, Brian, do you believe it would be a mistake to say that bad news for Walmart and bad news for Target isn't necessary?
Okay, traders, let's see what happened with Japanese yen. Okay, position was opened, as you can see, just right here at about 10 to 1 o'clock, 10 minutes, 12:55, let's say like this, yes? It moved down, we placed stop loss for our position, and it was closed just right here, as you can see. Okay, great trade. Okay, well done, guys. All of you who decided to trade, to follow my trade. In our case, we made, because 1 pip equals 100 pounds, we made 5 pips, as you can see, and we made 500 pounds. Okay, stay with me. We're still holding for today Bitcoin. It moved down, so you still have chance to purchase at the lower level. And I'll speak to you later. Okay, guys, stay safe.
Pretty brutal, unless you've just been super long leveraged, long energy on the S&P 500. Brian, I imagine you don't do that with clients. So talk to me about where you are comfortable taking pockets of risk in a market that's been absolutely battered this year.
So the part that's gotten battered the most, I would say, is the growth areas, mostly the lower quality growth names that don't have the established earnings behind them. What I would say for investors who are looking to maybe play a bounce or at least prepare for a recovery, if we do continue to see disinflation, if we see softer conditions, the bond market for now appears to be saying that the Fed has basically got it right from what's priced in, but the data is going to be ultimately what determines that. Playing high quality growth as sort of the first and primary source of the bounce, not right away, but I think once we get a few months of affirmative evidence that we're going to be in a moderating growth and a lower inflation environment, that seems to me like it's going to be the beneficiary.
So, Brian, you're forming an idea already on where the leadership will come from when we get that bounce.
Yes, that's right. And I think energy can't be completely out of the picture because we have the risk, I think, as your previous segment was discussing, about China reopening and the source of risk to higher demand leading to higher prices. We have supply catching up, but not quite fast enough. So I wouldn't take that part completely off the table, but obviously energy has already done quite well. So if you're looking for areas that have done extremely poorly that seem likeliest to bounce, I would say in that, again, if by the end of this year it feels more like 2019 than 2021, I think that will be very good for growth stocks.
Brian, talk to me about that, the chances of that happening, and when we'd start to see evidence of that happening. If that's your call, I'm not sure if it's your base case, you can tell me if it is. How would you know if you're right? When would you know if you're wrong? Over what time period are you looking for the data to come in and validate that call?
Well, I think Powell emphasized this in his last press conference. He needs to see the job market be more balanced. So right now we have 2 open jobs for every 1 unemployed worker. I think what the Fed would like to do is try to destroy as many of those open jobs, for lack of a better word, as possible, not destroying jobs where people are currently occupying them and not leading to a higher unemployment rate, but maybe just creating enough doubt or concern about the economy that enough companies are initiating hiring freezes, maybe not increasing pay as much and trying to just cool things down. And they feel like that, and wages are 70% of inflation, that will do enough to cool down the overall rate of inflation, especially in the services sector where it's been accelerating recently. So I want to see the JOLTS data. I'd like to see a quarter of the employment cost index come back down and start to decelerate. We are seeing the average hourly earnings numbers coming back down, not to low levels, but to sort of more moderate levels. And that mix of evidence in terms of wages, I think, is going to be the thing that really has the Fed keying off, because it can't do much about supply chains, and hopefully those are getting better, and it can't do much about energy. So it has to kind of focus on where it actually can have an effect on the real economy.
Is the frequency and timing of that release a problem? The JOLTS data is super dated, Brian. It's May 20th and we're going off March numbers. Is that problematic?
It is. That's like the biggest lag of any data point that we get. And the employment cost index is quarterly. So we're not going to even get the second quarter number until probably the end of July. So that certainly is a problem. That's why we're not looking for this bounce in the next few weeks. I wish we could say that over the summer we're going to have a really good stock market, but I think it's going to take time to amass enough evidence. We're probably not looking, and this is what the market is basically priced in as well. In the near term, we're pretty certain about what the Fed's going to do. They're going to be hiking 50 basis points, and then September it becomes sort of a coin flip between 25 and 50. If at that point the Fed, and even before September maybe, the Fed can say, we're thinking about taking our foot off the brake here just a little bit, not completely, but we're going to be hiking 25 instead of 50. I think that might be a key point for the markets to act off of.
Brian, just quickly though, if you believe that ECI and JOLTS data is going to be guiding this Fed to a greater degree than it has done in the past, you're also making the point that they're going to be late, and they're committed to being late, and this time not late by doing less, late by doing maybe too much. So is the bigger risk here that they do too much and not too little?
I think the risk between the economy overheating and running too hot with the Fed having to catch up and the risk of it running too cold are roughly back into balance now. For a while, I was worried about the too hot economy. And I think now there is a risk that the Fed, they're going to go 50 the next 2 meetings because, like you said, they're not going to have that information. But they do feel like they need to get back to neutral. And for now, the bond market seems to agree. So unless and until we see longer term rates falling because they think the Fed's overdone things, I still think that they're basically on the right track.
Brian, always awesome to catch up. Thank you, sir. Brian Nick there of Nuveen, going through some of the permutations, some of the calls for this market at the moment. About 13 minutes into this, I want to touch on bonds just quickly. Your 10-year 283, you'll remember 2 Mondays ago 320, so we've come all the way back in. About 21 basis points last week, and then again this week on the week by 5 or 6 basis points, maybe even 7 now. On a 2-year, up about a basis point to 262. But again, some people starting to whisper that perhaps we've seen the highs. I'm not sure how comfortable you can get with that idea after a couple of weeks of a rally on a treasury, but a 2-year yield that's come off the highs of 285 and down to about 262. And just to check in on the equity market 14 minutes in, we are down on the week. We're up on the session, though, on the S&P by 1%, on the NASDAQ by 1.2. Supporting sentiment this morning, bit of news out of China, cutting a key rate and lifting sentiment.
It's important that they are taking measures to support or stimulate the economy. I think really the most important measure that can be taken to support the economy and that will have the biggest impact on Chinese assets is whether they can get COVID under control.
That conversation up next.
What's happening on Wall Street?
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management. It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
We know that it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccine specifically, neutralize the virus, but not as efficiently because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number. And most of the time, when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
Important that they are taking measures to support or stimulate the economy, the monetary measures we've seen, and in terms of the rate cut, they've taken measures on the property and the mortgage side in recent days. But I think really the most important measure that can be taken to support the economy and that will have the biggest impact on Chinese assets is whether they can get COVID under control.
And whether we'll get the support for that economy. We got some of it. Chinese banks cutting a key rate for long-term loans by a record amount, lifting sentiment this morning after US equities over the last week lost more than $1 trillion. With more, here's Kaylee. Hey, Kaylee.
Hey, John, it's been brutal, but at least it's less brutal today. And that was definitely the case in Asia, where you saw equities as well as the Chinese yuan getting a lift. It's heading for its best week now since 2017, in part due to this 5-year loan prime rate cut we got overnight, down from 4.6% to 4.45%. That is the largest cut of this rate since it was revamped in 2019. It's worth noting that the 1-year LPR was left unchanged, but this 5-year rate is important because it is the reference for home mortgages. So in theory, it reduces those costs and helps counter weak loan demand, because of course we also got data out overnight from China showing that property loan growth has slowed to the lowest level in more than a decade, growing just 6% at the end of March from a year ago. That is the slowest pace of expansion going all the way back to 2009. And of course, that is caused in part by the slump in China's property sector, which we have long known has been under immense stress, but also the broader impact of COVID-related lockdowns. And really, John, that is what this all comes down to. How do you balance stimulating the economy, maintaining economic growth with COVID zero policy? Those two running counter to each other. Clearly, monetary and fiscal stimulus is something China has talked a lot about, but how far can it really go if you are still locking down large portions of the economy? And because of those lockdowns, our team here at Bloomberg Economics says that the Chinese economy will grow just 2% this year. Not only is that about 3.5 percentage points below China's own goal of 5.5%, that could potentially, for the first time since 1976, be a slower growth rate than the United States, because Bloomberg Economics thinks the U.S. will go 2.8% this year, John.
Unreal. Kelly, thank you. Kelly Lyons there. Just with a breakdown of some of the estimates. The low estimate from Bloomberg Economics at 2. I can give you the median. It's still pretty low considering. Median forecast for China's 22 GDP growth, 4%, just about 4%. That is a problem at the moment. Abby has some movers for you. Over the last year, it's all been about Chinese tech. Hey, Abby.
Hey, John. Well, lots of bullish price action this morning on that liquidity boost from the central bank in China. And one sector that's super sensitive, you were just talking about tech. Now, of course, China tech has been down over the last year, but a sensitive sector is the chip sector. Earlier, we are well off the highs. At the open, the SOX, the chip index, had been up 1.7%, now just up 0.4%. So we see some of the tech stocks rolling over at this point. We'll be digging into that. NVIDIA, which had been up in a big way earlier, now down a little bit. AMD down a little bit. Qualcomm hanging in there. But for China tech itself, the Golden Dragon China index is up for a second day, up 4.7%. In fact, John, up more than 30% from its bottom earlier this year. Whether or not it's the bottom, we don't know that. But after tumbling so much over the last year on regulatory concerns and concerns around the Chinese economy, that is certainly a boost. And then finally, John, China, of course, is the world's largest consumer of natural resources. Metal and mining stocks doing quite well, along with the metals themselves. Iron ore, copper popping sharply higher. FCX and Cleveland Cliffs higher on the day. But in this volatile environment, the chip sector, which had been popping so much earlier, now down. Let's see whether or not these gains stay in place.
Abby, thank you. Just to break down the growth expectations for China for you quickly. I know Jonathan Golub over at Credit Suisse loves the ECFC function, so I brought that up on China for you. Talked about that 4 handle on Chinese GDP. Median forecast 4.8% for GDP in China this year. Back up to 5.2 the year after, 5.2 the year after that. But you know what the trend is? We have seen a ton of downgrades on Chinese growth for this year. GDP expectations coming in, not going higher. Goldman, the latest. I think Nomura still has a 3 handle for this year. That's China. In the US, Bank of America publishing about 30 minutes ago, they're looking for more stag, more inflation. Their words, not mine, but you get the picture. Inflation forecasts higher, growth forecasts lower. They say this: the market is also starting to respond to the Fed's message with the kind of financial tightening needed to eventually achieve that near zero growth outcome by late next year. We revise our outlook to show even weaker growth next year and higher inflation as well. They are not the only bank to be doing that. From New York City, we'll get you the trading diary in just a moment, with equities pushing higher after a big week of losses once again. Equities up 0.8% on the S&P. From New York, this is Bloomberg.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
As long as the cycle continues to be inflationary, they just struggle a little bit more. And what we actually see, and we've done a whole bunch of quant work around this, is that when inflation is high and stubbornly high, you actually want to be in stuff that's more cyclical, beneficiaries of this. So energy stocks, material stocks, and the like. Not because these are the best stocks forever, but they're the best stocks for the moment.
Jonathan Golliver, Credit Suisse there, still bullish, still constructive. This equity market is something he wants to see a whole lot more of. Your equity market up 0.8%, and that's the price action. Here's the trading diary. President Biden on tour in Asia, staying in South Korea until Sunday, then meeting with the Prime Minister of Japan in Tokyo on Monday. Fed speak continues through the week with Bostic and George on deck next week. And then we get the FOMC minutes on a Wednesday and another round of jobless claims and US GDP on Thursday and personal income and spending data on Friday as well. From New York City, that does it for me. Enjoy your weekend if I don't see you. We'll be back a little bit later with Bloomberg Real Yield. This was the countdown to the open. This is Bloomberg TV.
city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in Sari stores every day, also on TV, radio, newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number Fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with Number Fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for Number Fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees. But for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired 2 consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fiero's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue a warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in a hospital, he died of complications due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic they had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack of the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker but pretending to be a foreign person.
Federal investigators have detained 1 man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Venergold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Venergold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Venergold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Venergold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why. He may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Venergold as an opportunity to leave that troubled home. Venergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Venergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Venergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Wiener Gold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and it will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environment, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 20, 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small and space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's just kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, 50 years, most of them we haven't seen coming. So the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. The asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
I kind of imagine in the future maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in. It's our existence at stake, right?
The pandemic has affected everyone in different ways. Some pass the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000.
Here's a stock that can change your life.
I see a stock going up and I buy it, and I just watch it until it stops going up, and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can overstate the online communities or social media's influence on financial markets.
A large group of inexperienced investors who discuss their plans on social media platform Reddit have shaken up the stock market in a big way.
The stock that everybody's talking about right now is GameStop.
Video game retailer GameStop is set to continue their head-spinning ascent today.
The revolutionaries on Reddit are spanking Wall Street's ass.
The more these stocks go up, the more the big guys are getting creamed and losing billions of dollars.
This isn't a wealthy person's game anymore. Anyone can play it.
I took up a little bit of a new hobby, and I am interested in day trading.
As an investor nowadays, you don't have to look a specific way. You don't have to wear specific clothes. You don't have to be doing it from a trading floor on Wall Street in like a high-rise building in downtown Manhattan.
The narrative of what's driving the markets is no longer being held in secret offices in New York and Boston of privileged people talking to other privileged people. It's right out in the open. It's on Twitter, it's on Reddit.
From brokerage apps to Discord channels and subreddits to TikTok finfluencers, one of the last holdouts in the world of disruption, finance is next in line.
Investing should be as ubiquitous as shopping online.
That's Vlad Tenev, the CEO of Robinhood, the online brokerage app, talking about how he wants his app to disrupt the world of stock trading like Amazon disrupted the world of home shopping.
And I think that speaks to exactly the mission that a platform like Robinhood has, which is to democratize investing.
Robinhood was started in 2013 by Vlad Tenev and Baiju Bhatt in, where else, Silicon Valley, as an alternative to the big brokerages, but with one big difference.
As they were building the social network around finances for people, they realized that there was a gap in the market and that free trading could become something that they could bring to the markets, they could disrupt the industry.
While no-fee trading is industry standard today, it was unheard of when it was first introduced.
The online brokerage industry was really innovative when they came on the scene 10, 15 years ago, but they kind of stopped innovating where you haven't seen those commissions come down beyond $5 or $6 or $7. Robinhood think that by offering zero commission that they're going to push people onto this platform.
And on top of no-fee trading, the customers Robinhood was courting have been long overlooked in the world of finance.
So the typical customer of a Charles Schwab, for example, is putting a lot more money in that brokerage account than the typical customer at Robinhood. Even today, with all of its popularity, the median account size is about $240.
There's Fidelities in the Schwabs and the E-Trades of the world. They look down their nose at those kind of accounts. I don't want a $1,000 account. They're just a headache. I want a $100,000 account.
And this is key here, right? Because the thing about Robinhood that's different than every other single brokerage platform is how easy it is to use.
The design of the Robinhood app really has in mind a user who might be coming at this absolutely cold.
The fonts are very well sized, the shapes, the colors, all of that is something that the founders of Robinhood paid really close attention to.
And by creating an interface that catered to a newer investor, they were able to gather a pretty healthy group of customers. And by 2019, they had about 10 million customers.
Those 10 million customers were a huge success story for Robinhood, but no one could have predicted its explosion after the arrival of COVID-19.
Remain indoors to the greatest extent, and 100% of the non-essential workforce must stay home.
What we saw when the pandemic hit was the growth of Robinhood users absolutely turbocharged. And oddly, you saw this surge in interest in stock trading. Then they saw the absolute surge in 2020 in customer growth.
And now, by many accounts, they have more than 20 million customers, which is pretty extraordinary. So the next step for them is to figure out how to monetize those users and how, even with their small account sizes, to get them to grow with the company and, as it releases more products, come along with them.
Robinhood would become one of the COVID economy's breakout successes. Robinhood traders, as they're called, became the shorthand explanation for the frenzy of often speculative retail investing after the pandemic lockdowns.
Kids wake up in the morning, they go on Robinhood. They're, in the shower, they check Robinhood. Kids are learning how the stock market works at 18 while they're at school, checking their phones in between classes because notifications pop up telling them what their stocks are doing that day.
With these new tools, millennials and Gen Z are investing in the market in ways their parents could have never even dreamt of.
That is sort of key when we talk about the divide between older and younger generations, is that the younger generation is exposed to so much more information and tools at their disposal to do what they want in the market.
The older generations, you never had the technology or the cost structure that you could play the markets like you can today. So you were stuck with giving your money to a professional investor and paying them a fee to do it.
When I speak to young kids, they tell me, I'm making mistakes, I'm losing money. I'm not a perfect investor, but I'm 18, and by the time I'm 30, which will be, 10 years from now, I'm gonna have interacted with the markets for a decade. And so it's a learning experience more so than anything else.
And you can look at it and you can say, wow, that's risk-taking, that's dumb, but if you could possibly shave 10, 20 years off your working life versus adding 5 years, I don't think you can fault people for that.
But Robinhood is only part of the puzzle. Sure, you can trade on it, but without research, information, and data, you're just blindly throwing darts at different stocks and hoping to strike it rich.
Wall Street forever has always run on what we now call narratives or memes. People telling rumors to each other have been around for 100 years.
On Wall Street, information is its own currency. Historically, either you had it or you didn't. And the people who had it had a huge advantage.
In the past, those narratives and memes didn't have a network effect. It would be one person telling another person over the phone. In fact, when I broke into this business in the 80s, a lot of people used to complain that they weren't on the call list to get those ideas.
Social media changed all of that.
Fast forward to 2021, that's being done on the internet now. And that's being done on Discord and Twitter and StockTwits and Reddit. And the impact is very similar, but orders and orders of magnitude larger.
As social media has played a bigger part in our lives, it's also played a bigger and kind of more important role in how people find investing ideas online and on these platforms.
How do those ideas spread? On TikTok. Yes, that TikTok.
Soon may the weatherman come to bring us sugar and tea and rum.
People aren't just going to it for sea shanty videos.
The personal finance hashtag on TikTok has garnered 3.5 billion views from its 1 billion monthly active users. By comparison, videos found under the cooking and health tips hashtag have 2.6 and 2.1 billion views respectively.
The trajectory of Robinhood and TikTok were literally on par.
What happened in the stock market this week? So the word of the week is expectations.
Absolutely essential that you guys understand the risks of shorting.
And Kayla Kilbride and Kyla Scanlon are two of those financial influencer TikTokers, also known as finfluencers.
I think people still care about fashion, they care about culture, but it's also like there's this big behemoth thing called the stock market that we really don't know a whole lot about, and it's gatekept behind the industry. And so people like want to unpack that. And so my audience is a lot of them are younger investors who are looking to hone their skills.
Tech in right up.
Kyla and Kayla are two of the more, let's say, professional TikTok influencers.
The Tesla ARK Bitcoin Biotech Risk Cluster.
I've been trading since high school, and it was a really interesting way for me to fill out my decision-making frameworks and to think about thinking. And I think that the more that we can have people thinking about finance, the better that we're going to progress as a society. I think it's a huge gap in our educational system.
If you're going to buy an option for a stock you think is going to go up, it's a call. So think of it like this. I made the options video where I was like, options are just like shopping. Rumor has it that this pallet's about to go up in price. So if I come in tomorrow, can I still buy it at said price? And a ton of women just like attacked that video and were like, you explain things so much better than my boyfriend or my professor, or like I could sit and listen to you all day. And I was like, this is what I was looking for.
But TikTok's algorithm does not reward calm and measured videos about responsible investing. It rewards this.
Watch this video for 30 seconds and you'll be rich for the rest of your life.
I try not to say the A word, the ALGO word, because TikTok listens to us.
The algorithm does impact how you feel. You know, you do notice which videos do better versus which videos do worse.
How do you catch someone's attention in less than 60 seconds? And how do you make it something that they're like, I need this in my life? Nearly impossible to do that in 60 seconds. But the people who perfect it are the people that you're going to watch and going to stick around.
And where people are sticking around? Reddit. And its nearly countless subreddits about finance. And by far the biggest one of those is Wall Street Bets.
There's a lot of social media platforms out there, but Reddit is like the social media platform for finance. Places like Wall Street Bets is where it all goes down.
Started in January 2012, it wasn't long before Wall Street Bets adopted a 4chan-like etiquette, leading to their tagline, like 4chan found a Bloomberg terminal.
We had all these unexplained stock moves, and we would be grasping for why stock XYZ jumped 20% in a day. And you would look at Wall Street Bets, and you would see people there talking about buying options in that stock, and it sort of, squared the circle, so to speak, and started making sense. And it was at that point that it was like, wow, we have to start paying attention to this.
Some people on the platform really spend tons of time, and others are just looking for entertainment and to have a little bit of fun, effectively gambling or looking for an outlet, trying to make a little bit of money.
Then on top of all of that, there were stimulus checks. Now, clearly this money is going to people who need to use that to eat, to live, but there's a lot of people who use this money to invest in the stock market.
And it's not just stock tips. People quote-unquote YOLO their entire life savings or stimulus checks on a single stock. They post what is called gain and loss porn, screen-grabbing staggering hits and misses on stocks for the entire community to see.
I'm about to lose everything.
And while some of the people on Wall Street Bets are novice investors, the community contains multitudes.
In one respect, what it did show us among these network groups is they are very sophisticated. They're not a bunch of ignorant people talking to other ignorant people.
And this is where the pieces of the puzzle all come together to wreak havoc on Wall Street for a solid week in early 2021.
It's pretty clear that the combination of more people having retail brokerage accounts and trading apps and more people being stuck at home looking for some kind of entertainment and some kind of community online came together in this very singular way.
What came together is GameStop.
Let's go back to the beginnings of what happened with GameStop a couple of years ago. On the boards like Reddit and StockTwits, a lot of people were talking about GameStop as being attractive value.
Some of them are even, Wall Street alums who left the industry and now still have access to tools that they can use to improve their financial well-being and make very good decisions. And I think Roaring Kitty is a perfect example of that.
GameStop is one of the most compelling asymmetric opportunities in the market today. Really, I don't understand how you could disagree with that.
At the same time that this crowd was talking it up, The hedge fund institutional crowd didn't like this stock at all, and it had the largest short interest of any stock in the New York Stock Exchange going into late 2020.
Short selling is a bet that a stock price will fall, and it's a fairly simple concept. An investor borrows a stock and then sells it. The investor is betting on buying the stock back later for a lower price before returning it to the original owner, pocketing the price difference.
What a short seller would tell you is that they almost act as a policeman in financial markets, or they're at least looking for companies that aren't what they say they are. And that can range anywhere from an outright fraud that some short sellers try to expose to just a company that's not worth as much as investors think it is.
The problem is, if the stock price rises, the short seller has to come up with the money to buy the stock back. And the more it rises, the more it costs. And that's what's called a short squeeze. And the hedge fund Melvin Capital was on the wrong end of that squeeze.
Melvin Capital lost over 50% of its money in the month of January alone, just from being caught in the short squeeze of the stock.
This is where the disruption comes in.
One of the most wild stories you're ever going to see. GameStop shares absolutely going nuts.
In less than a year, the company's stock has jumped from less than $3 a share to almost $350.
Cheers, everybody!
Roaring Kitty has turned $50,000 or so investment into some $14 million.
Whoa!
Investors all over social media use the free trading app Robinhood to wreak havoc on Wall Street.
They're actually piling on into some of these stocks to really hurt the professional short sellers.
And they all used Reddit, Twitter, TikTok, and Discord to tell one another to keep buying and, quote, hold the line and not sell GameStop.
People are getting cheerleaded for jumping in, buying at the highs. They're saying, keep going.
And it was working too, until
Thursday morning, the trading app Robinhood sent out this tweet. In light of current market volatility, we are restricting transactions, including GameStop.
People were really angry.
Robinhood was supposed to allow the regular people to play the same game these big boys are playing. But instead, we were all taken for schmucks, and they screwed us.
Shares of GameStop are jumping again now that retail investors are being allowed to buy shares of the stock.
But what we learned is that when people organize online, they have the ability to disrupt the market.
And it was a big sign. The ivory walls of the institution aren't as powerful as maybe the institutions want them to be. I don't know if pumping up GameStop was the best use of billions of dollars, but I think that as a signal to society, it was pretty interesting and powerful.
The GameStop saga was so impactful that both Vlad Tenev and Roaring Kitty were called in to testify before Congress to clarify each of their roles in the saga.
One thing that's emerged from the congressional hearings is that they're interested in how retail brokerages make money and whether they're keeping the best interest of their customers in mind, but it's pretty fuzzy as far as what they would actually do as a result.
While the frenzy around GameStop eventually subsided, it didn't take long for retail investors to find other areas to invest their money.
Take a look at Bitcoin going bananas over the weekend.
Bitcoin forms a brand new all-time high.
It was after GameStop started to drop that we saw Bitcoin really go up to over 60,000.
How much further does this rally have to run?
It's compelling to say that money shifted from one venue to the other.
While correlation doesn't equal causation, there's a chart out there showing an inverse correlation on meme stocks going down and cryptocurrencies going up.
There's definitely an aspect where people are making money on stocks and then moving, they're agnostic, they're not hedge funds. They can invest wherever the hell they want. It's a classic sort of momentum trade. They're going to wherever the winners are and they're willing to jump on and, ride it.
So whether it's meme stocks like GameStop, meme coins like Dogecoin, or entirely new ways to invest in art like NFTs, the new kind of retail investor is making its presence known.
Over the next 10, maybe 15 years, you're going to continue to see, whether by choice or by force, that baton go from older generations to younger generations. I don't think any single app is going to be the thing that disrupts. I think people are the disruptors.
How people get ideas about what to invest in has become increasingly entwined with social media. And as social media companies govern more and more of our lives, the fact that now they're tied in more intimately to people's wallets is something that we might want to understand better.
Usually what disruption, I think, means is technology comes in, whether it's blogs to the newspapers or online retailing to brick and mortar. They come in and they're in the same business, but they just do it in such a gigantic cost savings that it causes everybody to switch. Well, that's the risk that happens here, is that it's so much cheaper to just manage your own money. We're not there yet, but costs and conveniences are moving in that direction. So I'd say, Wall Street, you haven't been disrupted yet, but you could be in the coming years, and that the final chapter on this story hasn't been written.
Meet Bloomberg's own David Nicholson. Now, his happy place is out in the field, on the open road. But like the rest of the world lately, he's been working from home a lot more than he's used to. COVID-19 has prompted a massive urban exodus as professionals of every ilk yearn for more space to live and work. As a result, rural areas have exploded, and they're poised to experience a resurgence as more and more families pack up and leave the big city to try out life in the burbs. But there's one problem with that. Not all internet speeds are created equal. Anyone who might need to upload or download large files for a living may not want to pack up and move to that cabin in the woods just yet. Now, David's house isn't a cabin, but it is in the woods, and inexplicably, his internet is workable.
My internet is okay. I pay a lot for it. It's around $140 a month. The download speed's great, and the upload speed is terrible, which is really bad for my work because I have to upload these massive files. But I'm definitely one of the more lucky ones in this community. Just a few miles down the road, my buddy has awful internet.
It's usually under 2 down and under 0.2 up, so it's often unusable.
Some days it's around 1, and other times it'll drop down to about 0.2, 0.3.
I just want to be able to have internet at my house without having to go outside the normal ways of acquiring internet. It's really frustrating.
We're literally miles, a few miles away from downtown, and it just cuts off.
This is a problem, and the solutions are not there yet, because getting high-speed internet in rural areas en masse is something our providers may simply not be